So in public session we're dealing with the item number 4, which is no consent, no sale bill 2019. This private member's bill in the name of Deputy Pearse Doherty. I want to welcome the officials from the Department of Finance, Public Expenditure and Reform and from the Central Bank. And just to say that there are two very separate entities, and we acknowledge as a committee the independence of the Central Bank. In order to be more efficient with our time, we suggest that we have the joint session and the members acknowledge your independence also. A note on privilege then, I want to advise the witnesses that by virtue of 17(2)(I) of the Defamation Act 2009, witnesses are protected by absolute privilege in respect of their evidence to this committee. If you are directed by the committee to cease giving evidence in relation to a particular matter and you continue to do so, you are entitled thereafter only to a qualified privilege in respect of your evidence. You are directed that only evidence connected with the subject matter of these proceedings is to be given, and you are asked to represent or to respect parliamentary practice to the effect that where possible you should not criticise or make charges against any person or entity by name or in such a way as to make him or it identifiable. Members are reminded of long-standing parliamentary practice to the effect that members should not comment on, criticise or make charges against a person outside the House or an official either by name or in such a way as to make them identifiable. So if we deal with the first opening statement, which will come from the Central Bank. We might just do the two opening statements and then proceed with the questions. Please, Mr. Simon.
Well, thank you, Chair. Thank you, committee members, and thank you for the invitation to discuss the Central Bank's views on the No Consent, No Sale Bill. I'm joined by Gonya McAvoy, Director of Consumer Protection, and Vasilios Medouros, Director of Financial Stability. The Central Bank serves the public interest by safeguarding monetary and financial stability and by working to ensure that the financial system operates in the best interests of consumers and the wider economy. We treat the dual arms of our mandate, safeguarding stability and consumer protection, with equal weight. Our work in each domain is mutually reinforcing. Over the last decade, the Central Bank has proactively worked in conjunction with the Oireachtas, the government, state agencies and international counterparts to strengthen the solvency and stability of the financial sector and enhance protections for consumers. We believe that a strong consumer protection framework is essential. This is particularly the case for mortgage borrowers, as a mortgage is the most significant financial commitment for most families and individuals. That is precisely why we advocated for a legislative regime whereby borrowers would be protected regardless of whether their loans were held by a bank or a non-bank. This is now the case. Customers whose loans are sold to another firm maintain the same regulatory protections they had prior to the sale, including under the various statutory codes of conduct issued by the Central Bank. All firms must comply with these codes by law. This includes the Code of Conduct on Mortgage Arrears, the CCMA, which was put in place in 2009 to ensure the fair and transparent treatment of financially distressed borrowers. The CCMA includes requirements that arrangements be sustainable and based on a full assessment of the individual circumstances of the borrower, and that repossessions be used only as a last resort. Firms must also follow the mortgage arrears resolution process when dealing with borrowers facing arrears. Within the broader Irish consumer protection framework, there is significant support for those in arrears, including the Money Advice and Budgeting Service, the National Mortgage Arrears Resolution Service, the Personal Insolvency Regime and a Court Mental Service. Collectively, these protections have kept the vast majority of distressed borrowers in their homes, despite the scale of mortgage arrears experienced following the financial crisis. At the end of 2018, less than 1 in 16 mortgages relating to private dwelling homes are in arrears over 90 days. In 2018, there were 22,000 new restructuring arrangements for mortgages relating to private dwelling homes, and this brings the total number of private dwelling home loans categorised as restructured to over 110,000. In addition, over 3,000 distressed borrowers have secured personal insolvency arrangements, which return borrowers to solvency while keeping them in their home in over 95% of cases. The enactment of this bill will not offer new or existing borrowers any additional regulatory consumer protection, and it could have negative consequences for the functioning of the mortgage market, with wider implications for all mortgage borrowers. The enactment of the bill in its current form would hamper the ability of banks to access market-based sources of financing using mortgages as collateral, such as securitisation and covered bonds, and access to such forms of finance help diversify the funding base and achieve lower funding costs relative to issuing unsecured bonds. Constraints on the ability to mobilise mortgages as collateral to raise funding through these market-based channels could ultimately limit the availability or increase the cost of mortgage credit. At a time when the severe dysfunction in the Irish mortgage market is finally easing, this bill could unintentionally slow or even reverse this progress. It would certainly give further pause for thought for any firm considering entering the Irish market by increasing the cost of doing business in Ireland and effectively limiting the funding available for mortgage lending. We do not believe this is in the interest of current and future mortgage borrowers. During the financial crisis, the ability of Irish banks to post securitisation and covered bonds as collateral was crucial to allowing them to borrow from the euro system. Total monetary policy lending provided to Irish domiciled banks rose to a high of €140 billion towards the end of 2010, of which approximately 40% was collateralised by mortgage-related securities. The bill would render the type of asset transfers required to use these instruments effectively impossible. The euro system would have concerns about the realisation of such collateral in the event of a counterparty default. This in turn has the potential to restrict the capacity of Irish banks to access central bank funding. If banks cannot mobilise collateral quickly in times of financial stress, crises can get worse very quickly. While the bill makes an exception for failing or likely to fail banks, this is not sufficient. If banks are close to the point where they are deemed failing or likely to fail, they are likely to have taken actions such as reducing the availability of credit that would have harmed the economy. The entire focus of the resilience changes made over the last decade have been to try and prevent banks getting into a situation where they are failing or likely to fail, precisely to guard against the kind of event that trigger damage to the system, to businesses, households and consumers. The financial crisis serves as a stark reminder of the severe cost of financial instability to society as a whole. While there have been significant progress towards repairing the banking system, legacy vulnerabilities remain. The restrictions imposed by the bill would reduce the ability of the banking system to absorb future shocks, and ultimately these costs will be faced by households and businesses in Ireland. Over the last decade, a lot of work has been undertaken to enhance the resilience of the banking system. This has included increasing capital, reducing non-performing loans, and making funding sources more stable. We continue to expect banks to use a full toolkit to reduce NPLs. The ability to sell portfolios while ensuring full compliance with statutory consumer protections is important. Since the 2013 peak, the stock of NPLs held by the retail banks has declined by €67 billion, and around 12% of that reduction was achieved through residential loan portfolio sales. In our view, the introduction of the bill will significantly constrain the ability of banks to engage in portfolio sales and so limit their ability to deal with outstanding vulnerabilities from the crisis. These constraints will hinder the continued post-crisis recovery of the system, and crucially, it will reduce the ability of the system to deal with any future macroeconomic downturn and deterioration in asset quality. Put simply, this means the banking system is more likely to be impaired in times of stress and less capable of supplying credit to households and businesses. As the Governor noted at this committee on March 26th last week, the Central Bank has grave concerns about the bill, given its potentially far-reaching implications for the operation of the banking system and for consumers. While designed to give effect to a voluntary code dating back from 1991, the regulated financial services sector has changed fundamentally in the intervening 3 decades, and consumer protection has been strengthened significantly. The voluntary code has been superseded by statutory codes of conduct and wide-ranging and strong regulatory powers which are underpinned by intrusive supervision. As such, our view is that this bill will not offer borrowers any additional regulatory consumer protection and instead could have significant unintended consequences to the longer-term detriment of all borrowers. In that respect, we concur with the ECB's view that the bill, at a minimum, should undergo a thorough impact assessment to ensure it is in the best interests of consumers as a whole. Thank you.
Thank you very much, Mr. Sibley. Now, Mr. Tobin, deliver your statement.
I would like to thank the Joint Committee for inviting the Department of Finance to address it in relation to the matter of the detailed scrutiny of the Private Members No Consent, No Sale Bill 2019. I am accompanied today by Des Carville, Head of the Shareholding and Financial Advisory Division, and John Palmer and Gráinne Gagan of the Banking Division. I welcome this opportunity to briefly highlight the Department's views on this Private Members Bill. As requested, the Department submitted a very detailed submission addressing specific issues as outlined in the new Memorandum of Understanding on Private Members' Bills. As the Committee will be aware, the Department has engaged fully with Committee members on a significant number of Private Members' Bills recently. These include Deputy McGrath's Consumer Protection Regulation of Credit Servicing Firms Act, Deputy Doherty's Central Bank and Financial Services Authority of Ireland Act, Deputy Pringle's Fossil Fuel Divestment Act and Deputy Doherty's Central Bank Amendment Bill. In each case, we have sought to engage constructively in the pre-legislative scrutiny process. We have sought to give open and honest feedback regarding our views on the proposed legislation and the drafting of each of the bills. In a number of cases, we have successfully worked with the deputies to progress the draft legislation into law following government approval to do so. In particular, we have already worked with Oireachtas members to progress a number of pieces of legislation designed to enhance the protection for mortgage holders who are in arrears with their lenders, specifically Deputy McGrath's Consumer Protection Regulation of Credit Servicing Firms Act and currently Minister of State Boxer Moran's Land and Conveyancing Law Reform Amendment Bill. In relation to this specific private members' bill, we would share the grave concerns expressed by the Governor of the Central Bank when he appeared before this committee last week. We have two types of concerns about the bill. Firstly, in relation to the potential unintended consequences, and secondly, in relation to its timing. To deal with the second concern first, and as highlighted by the Governor last week, we would be very concerned about the potential implications of this bill for the financial stability of the banking sector and wider economy, coming so close as it does to Brexit. As regards the potential unintended consequences, our assessment is that the bill will lead to higher mortgage interest rates for customers, reduced availability of mortgage lending overall, potentially severely restrict Irish banks' capacity to access Euro system credit, institutions losing their ability to use securitisation, an increase in repossessions by banks as their ability to reduce NPLs through sales will be severely reduced, a reduction in new entrants and less competition in the Irish mortgage market, and significantly reduce the value of the state shareholding in the various banks. In terms of a money message, the Government is strongly of the view that one is required. There are direct and indirect costs to the Exchequer that we have outlined in our detailed submission to the Committee. The Department also believes that the bill is unconstitutional as it is currently drafted. The bill overrides existing contractual rights for persons who issued mortgages to sell them on to third parties and purports to introduce a unilateral alteration of existing contractual terms for mortgages. The mortgage holders concerned would have agreed as a condition to borrow that the mortgage could be sold on. In doing so, the bill is overriding or abrogating vested private property rights. Constitutionally, this can only be done in a proportionate manner and where justified by the exigencies of the common good. After consulting with the Office of the Attorney-General, the Department is of the view that the interference proposed by this bill is disproportionate and therefore unconstitutional. I know that the intention behind this bill is to help those who believe that they will be worse off as a result of their loan being sold. However, this bill will confer no additional protections and will only serve to cause significant harm to the mortgage market for consumers and to the economy more generally. We are happy to answer any questions the committee may have. Thank you.
Thank you very much, Mr. Tobin. Now, Deputy Doherty.
Thank you. I wasn't going to go first, but you don't want to.
Bring in Senator O'Donnell first if you want.
Senator O'Donnell, come in.
Okay. Senator O'Donnell, go ahead.
Are you certain, Pearse? Yeah. Thanks very much. Can I just ask, I suppose, to take the areas that both the Central Bank and the Department of Finance independently are against the import of this bill. So I suppose I just want to flesh out a bit more about the borrowers that are in difficulty in banks. And being the devil's advocate as to how this bill would not benefit them, in that would it not give them more rights in terms of their loans. And that's the premise really, and I just want to test that. And you make the point that it will bring about an increase in repossessions, an increase in interest rates, lack of competition to the market, and I'm going to leave out things like reduced securitisation, obviously access to the ECB in terms of funding, reduce the value of the state shareholding, and be unconstitutional. Getting really down to, I'm interested really in the context of the mortgage holder, the person who borrows from a bank in good faith and who are concerned then that their loans are being sold on to a fund, in which case they have not been consulted when the loans have been sold. So we read in the papers today, as many mortgage holders will, that the AIB sale to the fund, their fund, a 1 billion sale has gone through, if I'm to read in the papers, but it's actually, the closing date was today, to Evergreen. So if you could just deal with specifically, why would a mortgage holder not be put in a better position in terms of keeping their home under this legislation than what currently pertains? I'm not saying I agree with the legislation, but our job is to test whether the points being put by both Pearse and by both the Department and the Central Bank, do they stand up to scrutiny? So, Mr. Sibley first.
Thank you for the question. Just to, because so there's a lot of similarities between what we said in an opening statement and what Mr. Tobin referred to. They're not exactly the same. So some of the things there that you talked about, I didn't talk about the constitutional rights, or indeed say that interest rates would necessarily go up. But anyway, but I understand the thrust of the question. I mean, ultimately, the way I've been looking at this bill is it's as much a question about the overall protections that are in place for borrowers in distress, and there are in Ireland, in my view, and looking comparatively, very strong protections in place for mortgage borrowers. My own view, and this is based on a fair amount of work, is that those protections in place in Ireland are stronger than anywhere else in Europe, and probably beyond.
That's a very bold statement, Mr. Sibley.
Well,
and many mortgage holders wouldn't agree with you on that.
Well, if you look what's there, and in terms of both the work that we've done in terms of the Code of Conduct and Mortgage Arrears, the why, and we can Grania will come in, I'm sure, in terms of how that works. The broader Consumer Protection Code framework, how lenders have to engage with distressed borrowers, plus then the other protections that are in place and the other facilities that have been put in place by the state and also other non-state bodies, then you can see that there are a lot of protections in place, and we can also see the effectiveness of those protections. If we look at the peak of mortgage arrears in 2013, how many loans were in difficulty, in arrears at that point, and how much of the crisis has been dealt with through re-engagement, restructuring. So more than 100,000 loan accounts have been restructured that are currently on the books of the banks and the non-banks. More than 100,000 accounts have been restructured. And while I appreciate that it's very difficult circumstance the borrowers are in, so long as they are engaging with their lender, then typically that has resulted in arrangements coming through that have kept them in their home.
But Mr. Sibley, you could have a situation whereby that a borrower could be in compliance and up to date with their home mortgage, and there might be in arrears and other aspects of their loans, and all their loans could go as a group to a fund. And the other aspect, and I've brought it up many times before, is that with a bank, your average mortgage holder, there are aspects of the way the banks operate that I'm not happy about, but they have assurance around the banks are in the business of lending long term. So the banks structure a mortgage over 20, 25 years. Their loans could be sold, their home loan could be sold on to a fund who might be borrowing short, who effectively may be structured to be short-term loan vehicles, that they're borrowing money themselves over a 5-year period, and are suddenly taking on mortgages that might have 15 or 20 years left in them. So what assurance can they get that they will get the same rights and conditions that pertain when they're with the bank?
I mean, the framework that's in place, and maybe we can talk a little bit about those protections for those borrowers that are in distress and more broadly, apply regardless of whether a loan originates with a bank or is owned by a non-bank. Indeed, the retail credit firms have originated about a third of the loans that are on their books. It would be an odd situation if we were to say, or the state was to be comfortable with a position where we would say, well, you're in a worse position if you take a mortgage out with a retail credit firm than you are with a bank. In fact,
that's slightly different now.
No, but
the principle.
In terms of
in the time I have, I want to be quite narrow.
But in terms of the experience, the approach, the codes, the regulatory requirements, there is no difference between for a borrower who is with a bank and with a retail credit firm.
I'm zoning down on one specific question. That you've someone with a bank, someone with AIB yesterday. Their loan is sent on to a fund. That fund, many of the funds, we're being told that many of those funds have borrowed short-term in nature. In essence, they're highly geared. Their loan vehicles will borrow from, we'd say, pension funds themselves. They might only have borrowed that money for a 5-year period. They're taking on loans from banks that might have 20 or 25 years to run. So if we have a person coming to us and we're at the coalface dealing with people whose loans have been sold on, and the first inkling they get of their loan being sold on is when they get the letter through the post. We deal with these people on a daily basis, and the impact is quite enormous. So the question I suppose I want to ask is, what's there in the current legislation? And I would have concerns and I would have reservations about many aspects of this bill, but I think we're duty bound as a committee to test the veracity of all aspects. And I think no one denies what the bill is looking to do. So what I'm asking is to I suppose, to get comfort around it myself. Obviously, the regulation has been extended now to the funds, whereas it was previously just with the agents that were operating in the country itself. What assurance can you give to people that are mortgage holders that if their loan is being sold on from AIB or other institutions, permanent TSB to a fund, that they have as good a chance of staying in their home as they would have if the loan stayed with the institution?
So maybe if I start that, and then maybe we could talk a little bit more about the protections that are in place. So the same protections are in place, the same regulatory protections are in place regardless. We engaged with the Oireachtas to make sure that they stood both for banks and for retail credit firms, non-banks. And that was amended in 2015, and then with Deputy McGrath's bill, I think it was, that was extended in 2018. But regardless of that, all retail credit firms had to engage and had to comply with the codes, our codes. What we can see in terms of the evidence, both in terms of what we can see from our analysis of the information we get from both the banks and the non-banks, is that there are restructures taking place, there is engagement taking place. And unfortunately, when there is a loss of ownership, it is in similar proportions to the level of distress in the banks and the non-banks. So there isn't an increased propensity to foreclose in the non-banks to date, based on.
And if this legislation was to be enacted, what would be the major consequences for you in terms of the mortgage market, the way customers are treated, cost to customers? What do you believe would be the major impact?
So, as I've outlined, we would question whether it delivers anything much benefit in terms of actual real regulatory consumer protections. Notwithstanding, I understand the sentiment behind the bill and the questions that you raise. I would be concerned around what it means for the funding model of firms, of banks, overall how the mortgage market functions in Ireland, further discouragement for new entrants to be lending into the Irish market. We can see with relatively recent history, so not only are they using secured funding today, but with relatively recent history, so at the height of the crisis, a very, very significant amount of money. So 140 billion was the total drawdown from the Eurosystem, and 40% of that was based on mortgage security. So at a time of need, the concern or difficulty in accessing that funding would have pretty acute consequences from a financial stability perspective.
The impact on consumers?
Well, we've talked a number of times at this committee about the price of mortgages in Ireland, and we've talked about concerns around the level of competition in the mortgage market in Ireland. This certainly, to my mind, isn't going to encourage any new entrants to come in, because it limits in terms of the access to funding that they might use secured funding to fund mortgage lending. It would give concerns about the legal framework, I think, in Ireland, and also means that they would be stuck here.
Do you believe, well, finally then, before I go to Mr. Tobin, do you believe that to drive up the cost of interest rates for mortgage holders, and do you think to drive up the rate of repossessions by the institutions, the current mainstream institutions, for house repossessions?
So I don't have a crystal ball in terms of what will or won't happen. What I would say is that well,
your job is to advise. I mean, that's...
No, I understand that.
Yeah.
I understand that. But I'm not going to say if this bill's passed, then immediately we'll see interest rate hikes. But what I would say is that what we've seen over the last 2 or 3 years is we've seen a degree of increased competition in the market. We've seen increased differentiation in offerings within the market in terms of interest rates being charged. But I would say with this bill coming in, we would be unlikely to see a new entrant, certainly new banking entrants, and so it would stymie competition. I'm conscious that we talked around the CCMA and the protections that are in place. Maybe, Gráinne, you could
talk about that. So you're familiar with the Central Bank's Consumer Protection Framework, and in 2009 we introduced a code of conduct on mortgage arrears, and that was of particular importance because we recognised, I guess, that a number of borrowers had come through the financial crisis and were in financial distress, and that code sought to introduce protections for borrowers that were in or facing arrears, and it required many obligations on lenders, particularly that lenders have fair and transparent processes in place, that they consider each individual borrower's case on its own merits and on a case-by-case basis, and it's quite specific in terms of how borrowers engage, how lenders, be it banks or non-banks, engage with the borrower, up to and including assessing their individual financial position, working with them to come up to an arrangement that may, as you referred yourself, allow them to continue to remain in their home while still paying back their mortgage. And more importantly, and Ed alluded to this earlier on as well, in 2015 when we saw a trend emerging of banks selling loans on to non-banks, we very much advocated for the introduction of the 2015 Act, which is the Credit Servicing Firm Act, which ensured again that the protections afforded under the CCMA follow with the borrower. So it's irrespective of whether you are borrowing with a bank or indeed a non-bank, the protections remain and exist. Furthermore, we undertook a review last year, which again was published, on the effectiveness of the CCMA. And again, our findings were very much in the public domain, but very much found that for borrowers who engage with their lenders, the CCMA is working effectively as intended. And Ed referenced this data earlier. There's in excess of 110,000 restructured arrangements, of which 87% of those the borrower is meeting the terms of the arrangement, and the arrangement is working for those borrowers. It also found, I suppose, our review at that time found that banks and non-banks engage with the lenders and continue to put arrangements in place, and they honour existing arrangements. So where a loan has been sold by a bank to a non-bank, that the existing arrangement remains honoured. So we feel that there's quite a lot of protections in the existing consumer protection framework that very much keeps the borrowers who are in or facing arrears core and protected.
Mr. Tobin.
Okay, thanks, Senator. I mean, obviously, this issue is very emotive, and it's obviously very distressing for anyone who has been affected by the issue of mortgage arrears. And And firstly, I mean, I'd like to say that from the Department's point of view, from everybody here, I think we all have tremendous sympathy for anyone who has suffered from mortgage arrears and who has found themselves in this particular situation. I suppose the question we're here today to try and address is whether this bill actually helps people in those situations or not. I've no doubt that the bill is very well intentioned, and I fully accept the bona fides of Deputy Doherty in terms of trying to help mortgage holders in difficulty. But I suppose, you know, the role that we're being asked to play here today is to give our honest advice about our view in relation to this bill. Now you've asked, you know, specifically what you think are the implications for the mortgage holder, and I suppose I would.
As distinct, I think, as distinct from the institutions.
Yes, absolutely.
I want to.
Yeah, and I can see where you're coming from. And what I would do is, I would divide that into two, in a sense. And I suppose we first have the current mortgage holder, and then we have the future mortgage holder, if you like. Certainly, we're not convinced that for the current mortgage holder that this bill would necessarily do a lot for them. I think, you know, the reality is that if institutions can't sell non-performing loans, then the central bank and the regulators are still going to insist that they address them. And one of the ways that they could address them is by repossession. So I certainly think it is a plausible scenario that in a situation where loans can't be sold, you could see an increase in repossessions take place. Now, a bit like Mr. Sibley, I'm afraid I don't have a crystal ball. I'm not trying to predict the future, but I'm just trying to give an honest opinion of what might happen.
But as I said to Mr. Sibley, you're paid to advise. That's your role.
Indeed.
Yeah. Yeah.
And then I suppose just to come back to the issue of the future mortgage holder, because I think they need to be remembered in this as well. So, you know, people who are thinking about buying their first home, who are struggling to put together a deposit and pay for a mortgage. I think, again, you know, echoing what our colleagues from the Central Bank have said, in a situation where secured lending is more difficult, in other words, where the rights of borrowers are even further protected, I think it's quite likely that institutions will price that in to the interest rates that they choose to charge. And I note that the Banking and Payments Federation themselves have come out today and said that this bill will lead to an increase in the cost of mortgages for borrowers. So certainly, you know, the banks feel that they will have to price in the risk associated with this proposed piece of legislation. So that essentially would mean higher interest rates. Now, again, that may or may not happen. I can't tell you definitively that it's going to happen, but I think that would be a concern we'd have.
And finally, why do you believe the bill to be unconstitutional, Mr. Tobin?
Well, I think we echo again a lot of the sentiments that are in Appendix 3 of the Central Bank's submission in relation to the constitutionality point.
How do you differ from the central bank? What's your difference? What's your difference in terms of your views on the bill, your objections to the bill? What differentiates between the Department of Finance and the central bank?
Sorry, at the start, I thought you were asking the difference between the two organisations, and I was thinking,
no.
There are many of those, but
but are you on common ground? Well, we won't go into that today, but on this issue.
But I mean, obviously, we've consulted with the Office of the Attorney General, who would take a view in relation to the constitutionality of legislation, and based on that, our view would be that the bill, in terms of its proposed interference in terms of contractual law and property rights, would be disproportionate and therefore unconstitutional. So essentially, as you know, there are specific sections of the Constitution which set out quite rigorous rights in relation to personal property in Ireland, and those rights require that any interference has to be viewed as being proportionate. And of course, there are occasions when you can interfere with personal property rights in Ireland, and the marital home is one particular case in point. But it's a question as to whether that interference is viewed as proportionate or not. And based on discussions that we've had with the Attorney General's office, we would not be of the view that this proposed interference is proportionate, and therefore the bill is likely unconstitutional. Thank you.
Thank you. Deputy McGrath. Okay, thank you, Chair. I'd like to welcome the witnesses here today as well. Just on that point, Mr. Tobin, in relation to the constitutionality of the bill, this is an issue that has come up in a number of the correspondence that we have received. Are you saying that it is the position of the Attorney General that the bill, as presently drafted, is not constitutional?
Well, I think, you know, certainly our view, based on our conversations with the Attorney General's office, would be that it's not constitutional.
Yeah, I'm not asking your view now with respect. It's the view of the AG that I would hold in high regard in terms of constitutionality. What you're saying is, based on your discussions with the AG, your view is it's unconstitutional, but is that directly attributable to the AG?
It's my understanding that it is, but you know, obviously the Attorney General isn't here, so you know, and in general, the Attorney's office, I don't think, tends to give views on private members' bills, but directly to the Oireachtas. But our understanding is that it is their view; it is unconstitutional.
Okay, and the AG's advice is not published, but is made available to government. So, is it in written form? Not that we can see it, but has the department had correspondence with the AG in relation to the bill, or is it verbal?
Yes, we have had written correspondence.
Okay, and on that basis, you are conveying to the committee the view that the bill is unconstitutional? Is
likely to be unconstitutional, yeah.
And is that because of the retrospective nature of the application of the bill to mortgage contracts already written? Is that the key issue in terms of constitutionality?
I think certainly that is one of the issues, absolutely. But again, I think there is this broader issue around you know, what is a fair and proportionate interference with vested property rights in the state, and we would have concerns that there are clear constitutional and legal difficulties with the bill. I suppose there are two provisions in the Constitution that deal specifically with private property rights, Article 43(2) and Article 43. And I suppose the test, and again, apologies, I'm not a constitutional lawyer, so I don't claim to be an expert in constitutional law, but the bill appears to constitute an unjust attack on an individual's property rights. And any encroachment on private property rights must satisfy a proportionality test. And I suppose it's the question as to whether the bill satisfies that proportionality test or not. Now, obviously, you know, the committee and the Oireachtas may wish to get its own legal advice in relation to that, and that's up to yourselves. But that would be our view in relation to the legality issue.
Yeah, and the committee is engaging with the Office of Parliamentary Counsel, which is an independent office. We have a very preliminary paper from them on that retrospective question, but there will be a fuller assessment which will feed into the scrutiny report. But we will be preparing a report and we will have to come to a decision in relation to the bill, and so the constitutionality question is pertinent. The AG won't come in before us and give us the AG's view, so this is our opportunity to tease that out, and the Central Bank in their own detailed submission did raise issues on that front as well. It's my experience, having brought a bill through the system relatively recently, Deputy Doherty has brought legislation through the system as well, that to get a bill all the way through the system and actually enacted and into law, it requires a lot of technical support. It requires buy-in from the department, the parent department, parliamentary drafts people, and so on. And is it the position of the Department of Finance that it will not be cooperating or supporting the progression of this bill because you're fundamentally opposed to it?
Well, Deputy, the government has decided to oppose the bill in second stage. So it opposed the bill. So from that point of view, I suppose we act, at the pleasure of the government. So from that point of view, I don't think that the department will be in a position to assist unless the government changes its mind.
So unless the government changes its mind, the department won't be cooperating or supporting the progression of the bill in any way. Just to get down to brass tacks, because we might as well. I've been through this process and I know how it works. Just on the predictions that you've made as to the consequences of the bill, so you're being quite definitive. Higher interest rates, mortgage interest rates, reduced availability of mortgage lending, restricting the bank's capacity to access the euro system. Maybe if we just focus on that one for a moment, can you just take us through how this bill, if enacted, would impair the ability of the banks to access liquidity on the euro system, if that was so required? And if it's not for you, then I'll park it and I'll come to...
Yeah,
I have separate questions for Central Bank and I can stitch it into that.
Sure, yeah. I would think that given that President Draghi has written, I think, in the last 24 hours, it might be more appropriate for the Central Bank to answer that question.
Yeah, just finally, so for yourselves, and that is on the question of a money message. Now, it isn't for the government to decide whether a money message is required or not, but if the decision from Parliament is that a money message is required, then it is for the government to decide whether to grant one or not. And a preliminary view from Parliament is that a money message is not required. You disagree with that?
Certainly, the government's view is that a money message is required for a variety of reasons. The bill will have very significant costs for the Exchequer, I think, both directly and indirectly. We do have grave concerns in relation to the bill and its potential implications for the banking sector and for financial stability. We do believe that we will need extra resources to assess on an ongoing basis the implications of the bill. We would tend to agree with the Central Bank that we think it would be appropriate that an ex-ante independent impact assessment of the bill should be carried out. We have set out in quite a lot of detail in our submission the costs that we feel will arise resulting from the bill. We feel there will be additional costs for the Central Bank. There will be additional costs to the bank themselves, to banks themselves, and we think obviously there will be a substantial amount of additional costs or additional financial implications in terms of the wider economy, not least in relation to the potential impacts if, for example, compensation was to be claimed by individuals against the state who felt that their property rights were being interfered with.
But suffice to say, if the view from Parliament is that a money message is not required, then that assessment doesn't come into play.
it comes into play if the decision is one is required, and then you have to decide whether to grant one or not, and I think we know the answer to that.
Well, certainly our view would be that a money message is required, but okay. I fully accept what you're saying, that it's not, it's Parliament that ultimately decides that.
Okay, can I just move to the central bank? And you know, at the centre of all of this is the whole debate around non-performing loans and the requirements of the ECB SSM to reduce the level of NPLs within the Irish banking system down towards European norms or European average. Can you just give us a sense of where we are at overall on that front? Because we had another announcement from AIB just yesterday. All of the banks now are expressing confidence, I think, that they will have reached their required level of being at or close to the European norm by the end of the year. So this is actually all moving very quickly, and so the question of whether the bill applies or doesn't apply to existing mortgage contracts is pretty fundamental, actually. But can you give us an overall sense? Where are we at on NPLs within the Irish banking system? What level are they at now, taking account of recent announcements? And is it the case that they must be at 4 or 5% by the end of the year?
So the non-performing loans, I touched on it in my opening statement, have come down a very significant amount over the last 5-6 years. They're in and around 10% of total loan books in aggregate, in and around that number, having come down from in and around 31-32%, I think, at peak. There is a strong push from before SSM from the central bank, and as part of the SSM to continue to drive down non-performing loans in the system in a sustainable way. There is talk about this European average. That's a benchmark, but not a formal target, because typically there are lots and lots of banks that have very low levels of NPL, of non-performing loans, and a good few banks that have relatively high levels. So the average, there's very few at the average, if that makes sense. But there is a strong push to continue to address the NPL problem. We're making sure that it's done in a way that respects the consumer and makes sure that the consumers are protected. There is no hard target to hit European averages by the end of 2019.
But yet that keeps reappearing, that by the end of this year the banks have to have reached a certain level. I mean, like, we were out in Frankfurt a number of months ago and we put it directly to the then chair, Danielle Newey, and she categorically denied that there was any push on the banks to get to any particular figure. But it keeps coming up, and the banks keep telling us that they are required to reach the European average, and they tell us by the end of the year. So, like,
what we have asked for is clear, and actually this is consistent with what we were engaging with the banks on back in 2010. We've asked for clear strategies in order to bring down non-performing loans and the operational capability to plans to deliver those strategies. But there is no requirement to hit a European average by the end of 2019. The European average is used as a benchmark to are you above or below. But it isn't a hard target they're required to meet. Now, there's lots of work being done around non-performing loans, the categorisation of non-performing loans, including by the European Banking Authority, and around provisioning on non-performing loans to make sure that there are sufficient provisions held against those loans, and that I'm sure is impacting on both the pressure and the potential need to take additional provisions, is, I'm sure, impacting in terms of banks' desires to address this issue quickly. They're also incurring additional costs as a result, so it's probably in their interest to bring them down quicker.
Okay.
But there isn't a hard target.
So you addressed this in the detailed submission as well, but like, you have your own legal advice resources available to the central bank. On the question of whether the bill can be applied to existing mortgage contracts already written where the borrower has signed up to a contract that has a clause that explicitly permits the sale of that mortgage. What is the view of the central bank, having taken your own advice, as to whether or not the bill, if enacted, can cut through those existing contractual provisions, set them aside?
So, similar to Mr. Tobin, I'm definitely not a constitutional lawyer, and nor is it the role of the bank, I think, to give advice on the Constitution. We've been asked for our opinion, and looking at the draft legislation, our in-house team have highlighted a potential risk around the constitutionality, but that's not a matter for. I mean, I didn't include the reference to it in the opening statement. It's not a matter for us to opine on, I think, but clearly there would be. I think it clearly needs to be considered. Okay,
2 final questions. One is, and it's in the ECB letter as well, and you've referenced it, that the bill would benefit from an impact assessment, so an ex-ante impact assessment before the bill becomes law. What would the nature of that be? And what exactly would it be assessing, in your view, if it were to happen?
So, and it comes back a little bit to my earlier comment. So clearly, we can see the aspiration of the bill and the intent. We have raised the question or concern as to whether it truly adds to the regulatory protection that consumers have. So on one side of that impact assessment is to assess whether it's truly going to deliver additional protections for borrowers. And then on the other side, to consider independently the risks associated with it. And again, I've outlined our thoughts on that around the potential implications for the functioning of the market, the potential implications from a competition perspective, the potential implications from a financial stability perspective, and then that gives an opportunity to weigh those up in terms of costs and benefits of the bill, as one could reasonably expect of any intervention in such an important market. That it would be worth doing an impact assessment to make sure that both the intended and the unintended consequences are understood and weighed up.
And then very finally, Chair, just on the question of the impact that this bill would have on the ability of the banks to access funding. So, and you might perhaps just explain what this means, the reference in the ECB opinion on page 2, which is similar to what you have said in your own submission. The ECB notes that under Irish law, in order for credit institutions to issue asset-backed securities, covered bonds, or residential or special residential mortgage-backed promissory notes, or to create security over pools of credit claims, the underlying residential mortgages must be transferred, or in the case of a security interest, be capable of subsequent transfer. And it goes on to say that the bill would render that very difficult or impossible. So what does that mean in simple terms around the ability of the banks to access funding, and what are the consequences of that?
So in simple terms, it would make it very difficult or impossible, which is what the letter says, but maybe Pearse can talk about it.
Yeah, so in practice there are these financial instruments that institutions can issue that are backed by mortgages as collateral. Securitizations or covered bonds, for example. Financial institutions can issue those instruments to external investors to get funding, but crucially they can pledge these instruments as collateral with the Eurosystem, with central banks, to get funding, especially in periods liquidity, especially in periods of stress.
ECB liquidity.
ECB liquidity, that's right. So this mortgage-related collateral is the kind of vehicle through which central bank liquidity can be accessed. So if it, as a result of this bill, financial institutions cannot issue these mortgage-related instruments with mortgages collateral, this will constrain both their access to financial markets, but also importantly their ability to access central bank funding in periods of stress, which is one of the reasons we have flagged this concern from a financial stability perspective around the ability of the system to reduce the ability of the system to absorb shocks, because it will not have access, will have reduced access to central bank liquidity facilities.
Okay, thank you.
Just to make that kind of give a kind of real example of that, and I'm not trying to be alarmist, but we talked last week about Brexit and the risks around Brexit, and the view of the central bank is those risks are manageable from a financial system perspective. I would have a hard time saying that if I wasn't confident that the banking system could access Eurosystem liquidity if it needed it.
Thank you. Deputy Doherty.
Yeah, thank you. And I want to welcome our guests to this session. Maybe we'll pick up with that, and I'll then go to the department and back to the central bank later on with a further question. But when the central bank was before the committee last week, I think I outlined that the intention behind this bill is not to impact on the access to liquidity or indeed passive securitisation or access to ECB collateral. And I think that's very easily dealt with within committee stage of the legislation. I would be surprised if other members had different opinions, but that's up to themselves, and obviously the bill is now the committee's bill. But in relation to ensuring that those areas were exempt, because the thrust of this bill, what this bill is about, is actually the direct sale of a loan to a vulture fund. So in relation to financial stability that was mentioned, how far would that go to address that issue if those areas were exempt?
So, I mean, clearly we were asked for our view on the bill as it's drafted, so that's the view that we've given. If there was an ability to carve out Eurosystem funding and indeed wider securitisation and covered bonds and the like, clearly that would address a lot of the concerns that we have. I'm not sure it's that simple to do. I mean, if you take the PTSB example where they securitised, which was effectively a sale, so getting into the detail there to make that happen, I think would be a challenge. But clearly that is one of our most significant concerns with the bill. I don't know whether you'd add anything about it.
The only other point that I would add is that the other concerns around ability of the banking system to restructure its balance sheets in future times of macroeconomic stress. So in a future downturn, if there's a deterioration in asset quality, one of the key ways in which the system we can ensure it can absorb shocks rather than amplify them, it would be if it has the capacity and a range of tools to deal with this future deterioration in asset quality. That exemption, I'm not sure if it would cover that dimension of it.
No, it definitely wouldn't, because that goes to the core of what the bill is. The bill would not allow, without the consent of the borrower, the bank to sell on their loan to a vulture fund in the future, and that would apply for existing contracts here. But that would remove potentially a tool, given that it would be unlikely for many borrowers to give their consent to vultures, and we'll touch about it. Bit of that in a minute, but the banks have already taken a hit in relation to these loans. There are a number of other tools, are there not, where the bank could deal with those assets at that point in time. It's not a case that you would be leaving them bare in relation to dealing with distressed mortgages. There are a number of examples, for example, that are contained within the Code of Conduct on Mortgage Arrears that are non-obligatory, and indeed many banks don't use them, such as debt write-down, for example, and other measures that could be used.
So we certainly continue to expect all banks and non-banks to be using the full toolkit to address those loans that are in difficulty, and that would include engaging with borrowers, re-engaging with them, restructuring loans, write-off to the extent that it's relevant, other solutions that are there, such as mortgage to rent, the personal insolvency service, and the like, and ultimately, unfortunately, in some small number of cases, affecting the security.
Okay, thank you. And I'll come back to the central bank in a minute. Mr. Tobin, you said in questions in relation to the issue of my piece of legislation, the no consent, no sale bill, that it may or may not happen, and that was in the context of increasing interest mortgage rates. So which one is it? Because you've given a written submission here, which was well over the media all morning, telling us that you actually did have a crystal ball, and you told us that it was going to happen, that higher mortgage interest rates for consumers was going to take place. Now, can you inform us whether that was just on the back of what the bankers have been telling you? You've mentioned the Banking Federation's press release that they put out today. I'm definitely ruffling a couple of feathers within the banking industry in relation to this bill, or has the department carried out an analysis themselves that have come to this determination, given that the central bank hasn't included this in their opening statement?
Certainly, Deputy, I think that any proposed legislation that increases the cost of funding for banks will likely result in an increase in the cost of mortgages to households. So this is not meant as a personal attack on your piece of legislation. I mean, this is just, it would be a comment we would make in relation to any piece of legislation where we feel the cost of funding for banks is likely to increase.
Can I just, and I don't want to nitpick on this here, but this is, words are important. You don't actually say that it's likely to increase. You said that it will lead to. And it's surprising that the department are able to come to that conclusion, the same conclusion that the Bankers Federation come to.
And others, I think, as well.
Well, the central bank hasn't made that in their opening statement. And it is similar, it's nearly identical, actually, to the conclusion the department reached when Deputy McGrath was pushing through his own legislation in relation to regulating the vulture funds. Now, that's enacted how many months? 6 months now? Have interest rates increased, as you've warned?
Well, Deputy, all we can do is give our advice based on our view of what is likely to happen. I think in our submission we say that a number of things are likely to happen. That's section 1.2. But I mean, ultimately, we're here today to try and, if you like, tell truth to power, to tell you what we feel you need to hear, not what you want to hear. I'm sure you would much prefer if we told you that there won't be any impact on interest rates, but our view is that this is such a significant, potentially such a significant piece of legislation that could impact on the cost of funding for banks, that it is likely to result in an increase in the cost of mortgage rates.
But see, that is, I don't want to be pedantic here, but that is different from what you've said. You've issued a written statement which has been carried in the media today saying this bill will increase interest rates. You come in before the committee and you say that may or may not happen, and now you've qualified it to say that's likely or it's a potential.
But with respect, Mr. Chairman, I'm reading from our statement, I'm reading from our submission to the committee, which says in section 1.2, it is likely to result in higher mortgage interest rates for customers. That's what our statement says in writing.
This is your statement here, and you just delivered it about half an hour ago. You said our assessment is that the bill will lead to higher mortgage interest rates. So you're not sure whether it will or not?
We think it's likely to.
It's likely to, okay. And in relation to the regulation of the vulture funds bill, how come that your same observation didn't materialise in your view?
Well, I don't think necessarily the two bills are comparable in terms of their magnitude of impact. The bill, I think, that's before us today is considerably more radical in terms of what it's proposing to do. The previous private members' bill sought to regulate a particular actor in the market, whereas this piece of legislation essentially proposes to prohibit banks from selling mortgages. So I do think the two bills are quite different, and that this is a much more radical piece of legislation, which would likely have more radical implications as a result.
Yeah, that wasn't the question. Let me rephrase it. 6 months on after the enactment of the previous legislation that I mentioned, what's your view as to how come the warnings that the Department of Finance were placing on the record at that time, which was that that bill would lead to higher interest rates on consumers? Nobody wants that to happen. Hasn't materialised. Indeed, one would argue that interest rates have fallen. Have you had any assessment how the central bank's view on that piece of legislation, while less radical in your view, that warning didn't materialise and indeed the opposite has taken place?
Well, again, Deputy, as you say, that piece of legislation has only been on the statute books for a short number of months, so we haven't done any specific analysis of the implications of it. I think one of the likely implications of that piece of legislation is that fewer potential buyers now exist for portfolios of loans, because now essentially if you want to buy a portfolio of loans, you need to be a regulated entity, and some potential buyers won't want to go through that process necessarily. So it may well have had an impact in terms of the price that some of those portfolio loan sales are attracting. So I think that's a likely result from Deputy McGrath's piece of legislation. But I still think it's far too early to say yet, because it's only a number of months. But as I say, Deputy, all we can do is tell you what we think will happen. And Mr. Chairman, we're trying to be as helpful as we can to the committee and as open as we can be. So I'm sorry if some of this is not what you want to hear.
These are the valid and genuine views that are held by the department. I'm just here to tease them out and to test them, and that's all we're trying to do here. So we won't fall out.
I hope not.
Personally, anyway, in relation to this, I hope that I'll be looking for your assistance as we pass this through report stage and right through the Shannon and get it signed into law by the President, because that's my intention, and we will need the support of the department officials and indeed the central bank as we progress this piece of legislation. Can I ask you in relation to, which I think underpins some of the assessment from the Department of Finance and indeed the central bank, which is the regulatory framework for banks and vulture funds are entirely the same. I actually don't dispute that. But can I ask you, if you had a choice, where would you want your family home with? A vulture fund or one of the Main Street banks?
Well, Deputy, based on the evidence, I would have no particular preference.
Okay. The smile said a little bit more. Okay.
No, I just thought it was a clever question. That's why I smiled.
Okay. So, can I ask Mr. Sibley the same question?
I can understand why people are concerned, given all that's been said about the non-banks. So I can understand that narrative and why people are concerned. If I can answer a slightly different question, I'm sure you'll push me on the original. My advice to any borrower, particularly one in distress, regardless of whether they are with a bank or a non-bank, would be to be engaging with the lender, to be working through their issues with the lender, and to avail of the supports that are there, both through the codes and the wider framework that exists in Ireland.
Look, I would give the same advice and do give the same advice to individuals, and I'm not going to push you any further on that question. I think the way you...
I mean, another way of looking at it would be back to what I said earlier, is I would have no compunction about taking out a loan with a retail credit firm or a bank. I would look at it on the basis of the offering that was there.
Yeah, and that's also a valid point. The issue here is that, for example, if we deal with those that are working at the coalface with borrowers, with distressed debtors, for example, MABS, which was referenced in both your opening statements. MABS tells us that in approximately 75% of cases where loans have been sold, advisors report that the sale has both slowed progress and had limited options available to the borrower. That's the reality. We know that if we're dealing with, for example, the likes of Prometoria, they won't do mortgage to rent. There's certain options that you will have at on a Main Street bank that vulture funds will simply not do, will not entertain. And isn't that not the real crux of the issue here? That while they're regulated in the same way, while the Code of Conduct of Mortgage Arrears applies to both in the same way, you have different offerings from a vulture fund compared to a high street bank. And you are seriously at risk with a vulture fund. Because if you take Glen Bay, for example, a fund that was set up, a structure that was set up a number of weeks, 3 weeks before the sale of 6,000 loans, there is nothing to stop that vehicle and their servicing agents for increasing interest rates for those that have standard variable interest rate. There's nothing at all to stop them doing that, but there's also nothing to stop the bank from increasing the interest rates. The difference is that if the banks pushed up interest rates, the bank are looking at your agricultural loan, your student loan, they're looking at your deposit, whereas these vehicles have only one interest, and that is to get as much money as possible and make as much profit from the sale of the loans from the regulated entity in the first place. Isn't that not where the real risk lies here? And isn't that not why so many people, 95% of those who have loans sold to vultures, are in a position of personal distress as a result of this?
Well, I mean, maybe if I can start, I don't know if Mr. Sibley wants to add in. Looking at the review of the CCMA that the Central Bank carried out, and I'd reference figures 3 and 4, which are on page 37 and 39 of that publication. I mean, that shows that arrangement categories, it sets out the various arrangement categories for banks and non-banks. So, you know, as you'll be aware, some are interest only, term extension. There are a whole variety of different types of arrangement that are put in place by both the banks and the non-banks, and arrears capitalisation is used by both. Now, you could certainly say, based on I haven't seen the submission by MABS to the committee, so I can't specifically comment on that, but it is clear that banks and non-banks are choosing to put in a variety of arrangements. Now, they may be choosing to do them in different numbers, which may in itself reflect the fact that you know, perhaps some of the non-banks tend to be dealing with people in very long-term arrears often, because those often tend to be some of the loan portfolios that are sold. So you might put a different arrangement in place for that type of situation than you would for something that is less in arrears. But also, I mean, just looking at the latest repossession statistics, which if I'm quoting correctly, I mean, the banks are repossessing a lot more properties than the non-banks. So, I mean, I would just wonder, the CCMA review, which the Central Bank carried out, and again they may wish to comment, they, if I'm recalling correctly, they said that they didn't see an obvious difference in the treatment of mortgage arrears cases between the banks and the non-banks.
I think maybe before Mr. Sibley comes in, and you can answer, you can comment on this if you want. I don't have the report in front of me, but from memory, one of the findings of the report, or one of the comments on the report, was that it was actually early days in relation to the vulture funds, because the transfers have only recently happened, and whatever about the Code of Conduct and mortgage arrears, what it does is it creates a timing factor which has to go through the different steps before you can take the necessary legal proceedings. So
yeah, I think that is a fair point.
Since the actual report, I think we've seen a doubling of the number of family homes that have been sold to vulture funds since that report came out. So the issue here is, because we discussed this with the Central Bank last week, the issue here is that when we're dealing with people such as MABS, who are right in there right now, when we're dealing with the Irish Mortgage Holders Organisation, or FLAC, they're telling us a very different story. They're saying that this is not good, that 75% of cases they have reduced options as a result of being sold to a vulture fund, and you need to close the doors because these banks are lining up and these vultures are hovering and they're ready to pick off the carcasses of the economic fallout that happened in the state. And we have a duty as legislators to protect citizens and to do that in a balanced way. And I believe putting, Mr Sibley, your own code of practice, which you've had for 28 years, onto a statutory footing was the right way of doing that.
So, I mean, to come back to the original point, certainly in terms of what we can see, and we haven't seen the MAB submission, and obviously would be very, very happy to look at it and engage with MABs directly on it, is that in terms of approach that's been taken in terms of complying with the CCMA, in terms of having restructure arrangements that are either have transferred as part of the sale or are being put in place post a sale, that the retail credit firms are complying with the CCMA, they're engaging effectively with borrowers, and they're putting in from a range of options. Now, within the banks today, there are different options, different preferences in terms of how different borrowers are being treated, in terms of the solutions that are being put in place. So that is the case between the banks and the non-banks. That is no different. But we can see that there are restructuring arrangements being put in place. And indeed, I think it's worth maybe just talking a little bit about how we've been engaging with both the bank and the potential seller, buyer rather, in the case of those most material loan sales. So you'd have had PTSB and Pepper here in relation to that transaction last year. That was obviously a significant transaction involving loans that had primarily been restructured at that point, I think. And we had a very high level of engagement with PTSB, and we will continue to have very high levels of engagement with any potential seller to make sure that the risks to individual borrowers in that circumstance are understood and being mitigated, and that there are commitments made by the purchaser to make sure that those risks continue to be mitigated and addressed in the longer term post the sale. You're right, absolutely, that is early days, but our engagement through the process, certainly for the most significant sales, make sure that those risks are understood and there are commitments from both seller and buyer, and we can talk more about that if it's helpful.
Can I just finish up just very, very briefly? My concern here isn't just for the individuals whose loans are about to be sold off. You have a central bank report last April, which talk about those in long-term arrears, 720 days plus. The central bank themselves says more than 50% of them are likely to be lose ownership of their home either through voluntary possession or non-voluntary possession. That's a huge amount, about 15,000 homes coming down the track. But there's no loan that's safe from sale to a vulture fund. There's nothing to prevent AIB or Permanent TSB or Bank of Ireland selling a tracker mortgage or a group of tracker mortgages in the morning because they believe them to be loss-making or for whatever reason. There's nothing that can be done to stop that. Despite in some European countries that wouldn't be allowed. Austria, for example, Denmark, for example, they don't allow banks to sell performing loans in that way. So I'd want your comment in relation to that. And finally, in relation to the issue of the constitutionality of the legislation, again, you know, the department made a very strong view known. I'm mindful again that the department, or at least the Minister, I'm sure through advice of the department, told us the same thing when we were talking about removing the bank veto. But in 2016, the bank veto went, and we allowed people to appeal to the courts and have debt reduction imposed on banks. So we were told that that wouldn't be possible constitutionally. More so, the committee has to do its own piece of work, and we have, as Deputy McGrath said, the preliminary view in relation to the retrospective nature of the legislation and how it impacts on contracts, and it doesn't state that this is unconstitutional. I just think that's worth putting on the record here. We'll have to wait till we have the full advice. But the issue here, and this is what my problem is and I say this with respect, like, we have the department and the central bank who's got a role in terms of consumer protection, but you're out batting for the banks. Like, the issue of property rights in the Constitution is clearly there, but it clearly has limitations on it. And the limitations are whether the issue of social justice or the common good come into play. That is why back in 1976, legislation was introduced that said that you need the consent of your spouse before you sell the house, because of the section in the Constitution. That contractual rights were able to be torn up and said, no, you need the consent of your spouse before you sell the house. So because of the issue of the social good and social justice and common good. And really, the issue of the constitutionality of this has to be just tested in the courts. Because we've been here before, we've been at Part 5. It was told that Part 5 would be unconstitutional. We were told that removing the veto would be unconstitutional. We're told that, well, we're not told by our own legal advisors, but we're told by the department that they've got advice that this would be unconstitutional. The reality is this should be tested in the courts, and we need to allow this to proceed, in my view, because the social good is not served by allowing thousands upon thousands of struggling homeowners loans to be sold to unnamed vulture funds who refuse to come in before this committee, who none of us know who they are, vehicles that are set up just a number of weeks before the sales go through. And we know that the banks are rubbing their hands and couldn't believe that Permanent TSB got away with selling performing restructured loans, and that they're all lining up to do the same. And that's what's happening. And you know, unless we take action here, we'll sit back and we'll see the calamity that's awaiting us. And this legislation is part of that. And I would just maybe mention to Mr. Tobin in my last comment here on Deputy McGrath's comment, if this committee agrees to move into committee stage, I would hope that the department would proactively try and shape the legislation so that the legislation can have the best potential outcome, even though you may have reservations. It's happened in the past. The department opposed, for example, the fossil fuel divestment bill, and he's got involved in it at a later stage. So I hope that there is a point where our paths may meet and we can work together to having this piece of legislation enshrined into law. Thanks.
Okay. Well, Mr. Chairman, thank you. Obviously, Deputy Doherty, the Oireachtas is quite entitled to pass laws that are unconstitutional, if you so wish to do that. But you know, we're simply telling you or giving you our advice as to our view on its constitutionality or not. As regards your view that we're out batting for the banks, I personally don't accept that. In my view, what we're trying to do is to take a holistic view of what are the potential implications of this piece of legislation. And we're very mindful of the potential implications for people who are in mortgage arrears. And we would be concerned that, you know, there could be potentially increased repossession if banks can't sell their mortgages. That's one category. We're also very mindful of people who have existing mortgages, who, particularly those on standard variable rates, who may end up having to pay more by way of higher interest rates because the banks are finding it more difficult to raise funding. And we're also very mindful of people who in the future would like to take out a mortgage to buy their first home, who, as a result of this legislation, there may not be new entrants coming into the market, there may be reduced numbers of lenders in the market, or there may be higher interest rates. So, I mean, I fully accept and understand why your focus is on those who are in mortgage arrears, but I think, you know, given the potential radical nature of this bill, we of course have to think about those people, but we also have to think about everyone else who has a mortgage and what the implications are for them. And we also have to think about all of those young people who don't yet have mortgages but who would like to have them, and what the potential implications of this legislation may be.
Thanks, Kerlock, and thank you both for your opening statements. In terms of, I just want to put one thing on the record. I'm reading on the Irish or the RT website, it's the bill has already been passed by the Dáil, so I think it's past second stage, but we're now looking at pre-leg or scrutiny before committee stage. And I think people looking in may think that it's passed and it's nearly the whole way down, and it clearly isn't. But we're here to try and progress it or otherwise, and examine it and test it and so on. And we have a lot of briefing documents. I mean, there's the 22-page Department of Finance, there's a 4-page opening statement, obviously Central Bank and ECB opinion of 9 pages as well, and a lot of the points have been covered by the previous speakers. But I suppose the intention, I'm assuming, or I'm getting from Deputy Doherty and from what he said about it and what other people said about it, is it's about the kind of the joined-up thinking of we have people who are in distress, who are not able to comply with the original terms of their mortgage, and they are then being passed to a vulture fund so that the banks can now say we don't have NPLs in our books anymore. Vulture funds have them instead. But as Deputy or Senator O'Donnell outlined, the view from a lot of us here over the time I'm on this committee is that vulture funds have a different agenda. They're not typically in it for the long haul the way that the banks are here. They have branches, they have a presence, they're looking for new business, they're trying to participate in their communities to a greater or lesser extent. Vulture funds, it's a case of get in, get rid of the assets, get rid of the people who are in the, whether it's tenants, whether it's owner-occupiers, get them out, get the house sold, and then move on, get out of the country perhaps, having got as much as you can out of it. The Project Beach, the AIB one, I think it's 30 cents in the euro they're paying for those debts. Presumably they'll chase them all. As a country, we still own 3/4 of AIB. Whatever write-downs went into AIB have ultimately the hit has been taken by us, the shareholder, and it's looking at it from a state's perspective, and particularly this applies more probably to the Department of Finance. If people are taken out of houses, whether they be tenants, whether they be owner-occupiers, and they then present at a local authority, ultimately there's a cost for the state. Is there any impact analysis or looking at when NPLs, it's all fine, get the percentage down. There are lots of ways of doing that. You could restructure, you could do debt write-down. Nearly every bank has been into us saying they won't do debt write-down on an individual basis. They won't offer a loan for sale at 30 cents in the euro or 50 or 70 cents in the euro to an individual, but they'll sell them off to some, and it was the Governor last week pointed out that the value in having foreign investors, because it's foreign money that's taking the risk and it's foreign money coming into the country. It's a perspective I hadn't really heard before, but ultimately we have people who are going to be dispossessed out of their homes, who are going to lose, and yes, maybe they made bad calls, maybe they took on too much debt, we acknowledge that, but then they turn up at a local authority and we have to rehouse them. Is there any at all thinking that goes on between the Department of Finance and the Department of Housing in terms of would there be an opportunity sometimes to look at vulture funds differently? And to look at the non-performing loans, and maybe the state should take on some of these loans in a different way, take them out of the hands of the banks and deal with them, because ultimately we're passing on distressed loans.
Senator, thank you for the questions. I mean, obviously, I'm just looking at some statistics for new mortgage lending, and back in 2006, we were lending around 39 billion euro in mortgage lending, and you know, clearly, I think we're now at about 8.7 billion, which is substantially up from 2013 when we were 2.5 billion, and we're probably not back to quite normal levels of mortgage lending. But clearly, what was happening, you know, in the so-called bubble years was completely unsustainable, and obviously, the legacy of that casts a very long shadow, and it has impacted on on so many people's lives in really awful ways. Now, the reality is, that a lot has been done. We have, I think, as the Central Bank said, over 111,000 restructures of mortgages that have already taken place. The personal insolvency legislation that's been put in place in Ireland, I think, is widely praised internationally. The Awalia scheme that MABs are operating is helping. But the reality is that we have very, very long-term arrears now, 4-5 year arrears. Other countries often don't have arrears of that length of time, simply because they tend to repossess property much quicker than we do. So, it is an absolute challenge to try and resolve some of these issues, but it's certainly, I think, beyond the purview of the Department of Finance to suggest more structures that could be put in place. That would probably be a matter for our colleagues in the Department of Housing. But clearly the whole nature of banking in Ireland is changing right now. On foot of the financial crisis, the traditional banks have shrunk back from lending in a whole range of areas. They're being challenged by fintechs and others. The likelihood is that the non-banks, and I use that term very broadly, the role of the non-banks across a whole area of banking, not just mortgages, is likely to increase in the future. And we may all wish that the traditional high street banks would be the ones that we would have to engage with forevermore. But I'm afraid that isn't going to be the reality in the future. It's quite likely that people are going to be dealing with purely online banks, very soon. I think I think it would be a mistake to think that there's only one way or one type of institution that should be able to offer lending services in Ireland.
Well, I don't think I suggested that. But I mean, I'm not sure why you're responding in that way to me, because that wasn't the point I was making. The point I was making was there are lots of people out there who are potentially going to be affected by the transfer of the loan to an entity that may not have the same longer term interest that the person who currently holds their loan, or that they got their loan from, because by and large I'd say of that 39 billion, which is a staggering figure, it was primarily from the pillar banks such as they were at the time, and I accept that some of them are no longer on this island, but there wasn't the fintechs back then that were doing what they may be doing now. And of course we would all look back at that time and go, what were these people doing? Throwing out money to people with very little guarantees in a lot of cases, inflating the price of property in an enormous amount of cases. I know I was a councillor at the time, and the price of property in South Dublin was enormous, and it was increasing because the banks were lending people money. So if you could get 500,000, you got 500,000, and that meant the house price became 800,000. If you could only get 250, the house price could only be 500 or whatever. And these are figures that other parts of the country would probably find staggering, but they were quite low at the time in parts of the area that I represented. So I mean, the banks lent out money which inflated the prices, and then ultimately the whole thing came crashing down. The people were left with the debts and a property price that had collapsed. We know all that. But the point I was trying to get to was that we're going to have people who will turn up at our doors, public representatives, councillors, TDs, senators, saying, I'm being abused, and we have to find them a house. And the state is building them a house or accommodating them in a HAP system or a rental accommodation scheme. And I just feel that as a government, and you're civil servants, but as the government should maybe be taking into account some of that, saying not in all cases should we be transferring the loans to a vulture fund who are possibly in it for the quick buck, and that there should be some other vehicle that takes it off the banks, take the NPLs out of the banks themselves, a kind of a NAMA type operation maybe, takes it out and deals with it. But I get the impression that that doesn't exist.
Well, Senator, apologies if I misunderstood your question, but I mean, certainly from our perspective, as I say, some of that may be more appropriate to our colleagues in the Department of Housing. I would contend that the state is already very involved in the housing market in Ireland, and you know, I would be concerned that any time we try and do another intervention in the housing market, there tend to be quite a lot of unforeseen consequences. So, you know, it's not only with this bill do we think there could be unforeseen consequences. I think it's always a risk when you're dealing with the property market. And apologies.
We won't ask who it is.
So, I mean, I'm not sure that the Department of Finance would be recommending any further intervention in the property market right now.
I accept that, and I think as far back as Bacon reports, we were talking about whether intervention in the property market was a good or bad thing. In terms of your advice, were you, when you were looking at this bill, regarding retrospection to apply to it or not apply to it?
Well, I think certainly reading the bill, I think our view was that it does apply retrospectively. It would, yeah, it would appear to apply retrospectively.
It's just that we have a different opinion coming in from the Office of Parliamentary Legal Advice, more or less saying that retrospection doesn't apply currently, but if it did apply, well, then they'd have a different opinion than they have. So you took a view when you were forming your opinion on the current legislation as proposed that retrospection would apply.
Can I ask a question? Retrospection depends on what you're talking about. If you're talking in terms of retrospection about mortgages that have already been sold and transferred, that's not it.
But it can unsell loans that have been sold.
Sure, yeah. So we were taking the view that the way it was written, and we assumed that that was the policy intention, that it would apply to all existing future transfers of mortgages.
Future transfers of existing loans?
Yeah. Yeah.
Okay.
If that wasn't the intention, and Deputy Doherty can let us know, then it's more than likely that there might have been a different advice again from the AGs on that.
Obviously, it's a much more useful piece of legislation with retrospection than if it was only to apply to loans being taken out from whenever the legislation might be passed.
Again, I think, sorry to cut across you, but I think on that point, you know, if you are applying something retrospectively, which I think the intention is that it would apply retrospectively, then I think, you know, in order for it to be constitutional, I think there really is a case that it needs to be proportionate, and I suppose that's where the rubber hits the road.
Yeah, you have a phrase that it's disproportionate and therefore unconstitutional. Is there a constitutionality? I'm not a constitutional lawyer either, but is there a constitutional test that if something is disproportionate, it can't be constitutional?
I think that is an important concept. Now, again, I don't claim to be a constitutional lawyer either.
Okay. In terms of the reference to the voluntary code of practice, the Department of Finance is quite, I suppose, cutting them in terms of the draft bill is essentially a copy and paste of the outdated voluntary code of practice. And maybe just to ask then the Central Bank of Ireland, what are your thoughts on the code of practice? Outdated or voluntary or otherwise?
Yeah, so it dates back to a completely different time. So in 1991, I think there were 60-odd%, so nearly 2/3 of loans, mortgage loans, were with building societies. And I think, I wasn't here, and not many people were around in the central bank still from that time, that the concern was around some of the benefits associated with having a loan from a building society, certainly in terms of the context of demutualisation that was happening at that period, than anything else. I think that I understand that was certainly in the minds of the setting of the code. The mortgage market today, the financial market today, is clearly very different. It's much bigger, kind of many multiple sizes. There are no operating building societies in the state. Securitisation, use of collateral, didn't feature really in the 90s. Big feature now. the sophistication and of the Euro system support that's there, and indeed acting as a lender of last resort using potentially collateral, mortgage collateral, has all changed. We, as I understand it, looked at the code back in 2012 as our review of the Consumer Protection Code and decided at that point that we didn't want to put it on a statutory basis. At that point, my personal view is that we should have removed it. I don't think it's good practice for us to have voluntary codes that aren't being complied with. I don't think that's. I just don't think we should have them. And I think we should have dealt with it then. We didn't. But our view is that it is been superseded both by the nature of how the financial system has changed, and importantly, in terms of the protections that are in place, regardless of whether you have a loan with a bank or a retail credit firm. I don't know whether you had anything to that.
No, I would echo all of the comments that are mentioned, and to note as well that as a voluntary code back in 1991, the central bank's regulatory powers didn't apply, and we didn't have the full suite of our powers couldn't be imposed on a voluntary code. And I think Ed has rightly said, both in his opening statement and just now, that it has been superseded by a number of statutory powers through codes, through legislation and otherwise, which do allow the central bank to enforce its full suite of regulatory powers.
So, does it still exist, and is it about to be deleted or withdrawn, or what is its status?
So it still exists. We've put it in a submission. I touched on it in the opening statement. Is that it is superseded. We don't think there's a place for voluntary codes generally. I mean, we give guidelines and the like, which we do expect to comply with, but they're not on a statutory footing, and we would be intending to remove it.
So, and what is the timeline for? I mean, you're saying it's not effectively not being used, but it's still there. It's still available. It's still.
We view it as redundant, because it has been superseded by so many regulatory and legislative powers, and it would be our intention in the very near future to remove it from the website.
So that'll be in the next few months, sir?
Yes, without it, yes.
Okay. Just in terms of your second page, the enactment of this bill will not offer new or existing borrowers any additional regulatory consumer protection, and it could have negative consequences for the functioning of the mortgage market, which you've outlined. There is absolutely, in your view, no single benefit to an individual borrower of this particular legislation. Is that what you're saying? There's nothing in it for them at all.
So
it annoys banks. We get that, and
no. I mean, just to be clear, in relation to an earlier comment, I don't care a jot about individual banks. Not one jot. What I care about is the functioning of the system, how the system serves the economy, how it serves consumers, and to make sure that the events that we had happen in Ireland never happen again. So, and what we're trying to give is a view in the round as to our perspectives on the functioning of the market and how this bill connects with that functioning. So I do, and I said it earlier, I do understand why there is a nervousness on this issue and the narrative, and indeed I'm very keen to see that the MAB submission, and obviously would take that into our increasingly intensive work that we do with the retail credit firms. What we're saying is that from a regulatory protection perspective, from what we expect of firms, bank or non-bank, that exists whether your loan is with a bank or with a non-bank. The protections, our expectations are the same, and we will be increasingly intrusive in our supervision based on the increasing prominence of the retail credit firms, to make sure that is the reality. And we will see, as has been touched on, and is already the case today, that retail credit firms are writing business in the state today. We would expect that that business is being written and that business is being bought, those borrowers, those individuals are treated in exactly the same way and subject to exactly the same protections.
So are you saying, I mean, thanks, Kieran. Just in terms of the vulture fund, I mean, obviously the name itself, and they're probably a relatively recent concept in the Irish financial services sector. Anybody would be, I think, a bit worried if they thought their loan was going to it. But you're saying that there is absolutely no greater value other than perhaps the existing banks have taken a more benign approach towards maybe non-performers than the vulture funds are likely to do. Would that be a reasonable assessment?
What we can see is there are differences across. Again, sorry, I touched on this a little earlier. There are differences across the banks in terms of some of the decisions that they're making. There are differences between the banks and the non-banks in terms of the prominence of certain solutions. But all firms, bank and non-bank, are engaging and offering restructuring. What we can also see is and I really do appreciate that I'm talking about individuals here, but as a proportion of those loans that are in distress, there currently is no greater propensity to take legal action for the non-banks and the banks. It's about the same. And so now I appreciate for anyone in that circumstance how that feels. But that's the evidence that we see, and as I said, we would be keen to understand what MABs have submitted, and we would certainly take that into our ongoing supervision.
Okay, just in terms of, and I don't think anyone else has covered it, just the ECB came out yesterday morning with their opinion. Obviously, you're very much involved with the ECB, you're effectively a part of the ECB as the Irish Central Bank. Is there anything in their statement? We didn't read it out, but I mean, I read it. It's full of nice European jargon and lots of references to articles and treaties and so on. But ultimately, it's not keen on it. It's very keen on, it's very obvious that it's not keen. It doesn't really say anything differently than either Department of Finance or yourselves have said. But is there anything that you want us to particularly pick up on from their statement?
So the clear concern that comes out of the ECB opinion, just to simplify it down, really is two things: is the access to three things about that. The access to the Eurosystem funding, both in kind of normal times and in distress. What that will do in terms of the kind of normal functioning of the market and the need to undertake an impact assessment. I don't think that.
Okay, thanks.
Senator Conway Welch, please.
I hear like a lot of the questions have been asked at this stage, but I just wanted to ask, I suppose, both of you in terms of your analysis. You identify all the negative externalities. Did you come across any positive externalities, particularly for the consumer?
The only thing positive I can say about the bill is that it's short.
What do you mean by that?
Well, it's only 4 or 5 pages, so I appreciate that it's quite succinctly drafted, but I didn't see any positive aspects for the consumer in the bill as currently drafted.
Okay, and just for yourselves, did you see anything positive in terms of your consumer protection role?
So, the way we have looked at this is to try and look at it in the round for all consumers and the functioning of the market for consumers. And we think that there are certainly risks for all consumers associated with how the market functions, pricing associated with that, and the wider stability of the system. I can understand why there is a perception that's been articulated that borrowers would prefer not to have their loan transferred from a bank to a non-bank, and I can understand why that would have perceived benefits.
Okay, just in terms of the wider economy, obviously we're talking about being transferred once, but obviously with a lot of vulture funds and that, this could be flipped over very many times. Do you see that as being a negative, or any negative consequences of that for the economy?
So,
in terms of the same mortgage being sold over and over again?
I mean, again, like what we can see is what's been happening to date. I think there are a range of potential investors including those that, I mean, if you look in different jurisdictions, there are a lot of investors, say, in Denmark, and indeed in the Netherlands and other jurisdictions which are non-banks but are typically pension funds and insurance firms that are looking for stable rates of return over a long period of time. There are different investors in the US, different investors elsewhere that are looking for different things. Not all of them are looking for to flip mortgages.
But you don't have any control, do you? I mean, it's purely at the discretion of the budget fund. You don't have any control how many times it's flipped or where it ends up.
So what we would expect is that if, and Grania can talk more about this, is that if loans are being sold, that they would be engaging with us around their intent and how any risks associated with that, with those sales would be mitigated. So
do they have to do that?
Yes.
Legally?
Yes, they, in accordance with the provisions of the Central Bank's codes, any lender or bank or non-bank who intends to sell the loan must notify the borrower 2 months in advance. They must provide the borrower with information as regards the name and address of the acquirer of the loan, and indeed if it's going to be serviced by a different party, to provide the contact details for them as well. And we would have very strong expectations that if a borrower is on an arrangement and they're meeting the terms of those arrangements, that when the loan is sold, that the arrangement will continue in place for that borrower. And if the borrower was in a position maybe where they weren't, or their position changed, and if they weren't able to meet the terms of the arrangement, that would be assessed in line with the Code of Conduct on Mortgage Arrears, where the individual borrower's circumstances would be taken into account, and an arrangement or some repayment model would be introduced that best suited the changing needs or the changing financial position.
Could they be sold outside the EU? Could they be sold? Have you any control worldwide where they might end up?
So the law introduced the end of...
And when you say strong expectations, I mean, is that set in, is it legal?
So while the 2018 Act introduced at the end of the year requires that anybody acquiring a loan had to be located here in the state. So I think that probably...
So anybody from outside the state couldn't... So, okay.
So the credit servicing firm legislation introduced requires the regulation by the loan owner by the central bank. So that means that they have to be established here.
But I mean, before that, since 2015, the activity, the approach to engaging with borrowers in distress, not in distress, is no different between the requirements are no different between a bank and a retail credit firm.
Yeah, I'm just trying to get it because you see for us in terms of even say Glen Bay, for instance, it's pretty confusing for us how we cannot find out who are the beneficiaries. Who are the beneficiaries of that? So if these mortgages keep getting flipped over and there's more and more less transparency around it.
So this is why...
I suppose we need, all of us as consumers collectively and as citizens need to have confidence in the system that's there.
So, and I fully agree with that. And that's why it's so important that the work that's done around the credit servicing firm, the activity of engaging, making decisions around restructuring to the extent that it's required, any engagement between a borrower and the loan, the servicing firm is regulated activity and subject to our codes. Now, with the additional legislation that's brought in last year, there has to be a vehicle in the state. We'll see how that plays through in terms of how those vehicles are set up. In line with the legislation.
Okay, but that's just the vehicle, obviously. That's not the end beneficiary from these mortgages. They can be outside the state. They can be.
I mean, this is the case across all firms. So who ultimately owns the firm? Who ultimately benefits from any profits made within the firm? I mean, you could say the same for who's the ultimate shareholder for banks, and how does that impact in terms of decisions?
So can you see why people would have less confidence in a vulture fund than they would have in a bank that they choose in the first place to make the big decision of taking out their mortgage from? You know, I think that's.
So as I've said a couple of times already, I can understand why people are concerned, particularly with the narrative that's in the system. What we are making sure that is in place is that what we have made sure is in place is the protections that are blind to whether it's a bank or a non-bank. And we will continue to discharge our responsibilities in terms of the intensity of asset provision of those firms, and the activity and the engagement between borrower and lender is critically important.
Okay. I wish I could share your confidence, but I just need to ask you in terms of the assumptions that you have made, say, within this, in terms of increase in interest rates, increase in repossessions, and all of that. Could you see that these properties being sold to vulture funds and maybe flipped on and all of that, could you see that may increase repossessions as well? So the decision could be made overnight. Somebody is going to pull out of the market. I mean, these vulture funds are going to be making hard business decisions. Could you see that would increase repossessions?
Senator, I can certainly understand the question and where you're coming from with it. I mean, and again, a bit like Mr. Sibley has said, I fully understand that people may have concerns in relation to their loans being sold to anyone really, other than the bank that they're used to dealing with. But the reality is that loan owners, when they tend to buy loans, obviously there is a profit motivation. They want to, they want to realise a benefit as quickly as they can. And to be quite frank, I mean, in Ireland, repossession is not a quick process.
No, well, what I'm trying to get at is, say we're at the top of the housing market now, or we're very near it, where it's very overheated. So if you're making a business decision around that, and you have all these properties that are very high in value, and impact of Brexit and all that, that you may make a projection that housing prices are actually going to go down in the future, you may make the decision to sell, which may end up as a lot of repossessions. Could that happen? That's what I'm asking you, because you were very certain in terms of repossessions.
Senator, if I could just come in on that, because you mentioned the Project Glenbeigh transaction, the recent PTSB transaction, and I think one thing which is overlooked was, while the identity of the purchaser hasn't been disclosed, I think there's enough information out there around the type of purchaser. So it's what we call patient capital, so it's a long-term pension fund investor who's interested in a very consistent yield rather than a quick flip of an asset. I think that's quite important, and what a lot of these private equity firms try and do, and their business model is really based around this, which is to restructure.
I understand, and I really don't want to use up my time with it. I completely understand how they work and the models that are used. I'm trying to just ask a very simple question. If the vulture funds decided that we had reached peak market and they decided to sell off a whole lot of portfolios, could that lead to increased repossessions in the Irish housing market?
Well, from the private equity owner's point of view, at that stage, they attract a higher valuation if they can sell a performing portfolio rather than a non-performing portfolio. So their business model is actually around restructuring the portfolio rather than trying to repossess, and that's why the repossession statistics are so low. And what they'll typically do is sell on to somebody else who's looking for a long-term yield rather than a short-term asset play, quick flip.
Okay. And I don't share your confidence again in how the operation works. Just in terms of looking at the vulture funds, maybe the impact on the economy in introducing them in the first place and then allowing them to get a bigger and bigger foothold in it, have you done an analysis of the cost of the tax loopholes, say the Section 110s within the department? How much is it costing?
Well, obviously we work in the banking division of the department, and so we don't work on the in the tax division. I'm not aware that an impact assessment of Section 110 has been carried out. Now, obviously, Section 110 was introduced as provision to provide for passive securitisation, bankruptcy remoteness. But to answer your question, I'm not aware that there has been analysis, but obviously that would be for our colleagues in the tax division.
But you see, when you say this is a cost to the Exchequer, and some of the language used is quite alarming, because if this bill was to go through, we might have an Armageddon situation. So I'm trying to look at what you compared it against. And I would have thought it would be fairly basic to look at the Section 110s and see what vulture funds are already costing us, what they're already costing us in terms of manipulation of the market, and what they're costing us in terms of the loopholes would be the two fairly.
Well, again, now I'm speaking as someone who doesn't work in the tax division, but I'm aware, obviously, that a number of changes have been made to Section 110 in recent years, and in general, and I think Deputy Doherty was probably heavily involved in quite a number of those changes to Section 110. So I would imagine, as part of that legislative process, an analysis would have been carried out in relation to Section 110. Now, I'm not aware that there were costings done, but as with any and all of these legislative provisions, they do tend to be kept under review on an annual basis as part of the finance bill process. That's probably as much as I could say.
I think it's very important that it is, not just kept under review, but that there is a cost put at an annual basis. I think this is something that we need to look at as a committee as well, but it's something that I probably took for granted that the department would do anyway. I just want to ask you about the loans that are identified as fitting the non-performing criteria. Are you satisfied that all loans sold fit the non-performing criteria? Because obviously at the end of the day, the rationale that you would have for vulture funds is that we need to reduce the non-performing loans. Do we know that it's not reducing performing loans as well?
So that's a question for the Central Bank?
Well, probably for both of you, but yeah, you can answer it.
I mean, sorry, just to jump in at the start. I suppose it's an interesting question. I think, there probably isn't much incentive for banks to sell performing loans because, they're making money from them. If you know what I mean. There certainly could be an incentive to sell non-performing loans because clearly, they may feel they're not making a return on them. But performing loans, generally, a bank, I would imagine, would in general want to keep those, unless maybe if they were exiting the market.
There's an example a couple of years ago of PTSB selling a £6.5 billion sterling loan book of performing loans, but that was part of its EU-mandated restructuring plan. So, as Gary says, I mean, there are some, like these kind of transactions do happen, but they are generally the exception rather than the norm. And in that case, there is a specific reason, a very specific reason, which related to state aid implications for that, but they are the exception.
Yeah, I mean, the people I come across that are, they've restructured their mortgages, all right, but they're fulfilling all their commitments, and they're assuming that they're performing in terms of paying, whether it be interest only or whatever, reduced. And they're very shocked to find out that they're classified as being non-performing loans.
Yeah, and that's a really important point, Senator, because there is a difference, a very important difference between a restructured loan and a non-performing loan. So sometimes a restructured loan can still be regarded under, I think it's the central banking content is better than I can, but under EBA definitions as a non-performing loan.
So certainly, if it would be helpful, we could provide more detail on the classification of loans, whether they're performing, non-performing, and what it takes for a loan to become back from non-performing to performing for bond, which is how we would describe it. And it is possible that a loan would be restructured and meeting their terms and still to be classified as non-performing. but we can, if you,
And if it doesn't,
there's some complexity to that. I'm happy
and
to
if it doesn't
explain
meet
to
the
you.
categorisation, say, from a central bank point of view, so what would the central bank do about it? So if they find that somebody comes to you and says, my mortgage was performing and it meets all this criteria, what would you do? What would your course of action be?
So, I'm thinking part of the purpose of the bill, and we talked about this earlier, is that actually it's not for the central bank to stop a sale of a performing loan or a non-performing loan. But what we ensure that we do is to make sure that the risks associated with loan sales to consumers are understood and mitigated. There are differences in treatment, as I've talked about, in terms of across the banks, and there are differences in approach to what we would describe as curing non-performing loans back to a performing status. And some of those choices involve banks incurring more costs than they would like, and result in them making different decisions. But as I said, I'm very happy. We can get into it now. It's quite complex. So I'm very happy to kind of
No,
follow
it's
up
fine. But just answer me this: they can sell off performing loans, can they? Banks can sell off performing loans without any impediment.
Mr. Carville has given you an example of
so they
PTSB
can.
doing that. Yes.
They can, yeah. Yeah, I'm only going to ask this final question. Do you think that, I suppose part of the intention here is to close off the option of selling on the mortgage. Could it have the effect of forcing the banks to give the right down to the mortgage holder instead of to the vulture fund? Could it? Just if they want to sell it, they wanted to get it off their books, why could they not give that to the mortgage holder?
So, I mean, it's purely hypotheticals, and if the banks were prevented from selling, they would have the same options available to them in terms of dealing with that loan as the non-bank purchaser, which is what we would expect them to be doing, is to continue to try and re-engage with the borrower to the extent that they can re-engage, to work through the individual circumstances of the borrower, to restructure appropriately according to the individual circumstances of the borrower, and work it out as much as possible. And in the case that the borrower wasn't engaging, or for other reasons such as the loan being simply unaffordable, then ultimately they would end up going through either the personal insolvency or the legal process. So I would expect the process to be followed the same for a bank and a non-bank, regardless of where the loan resides.
So it could include a haircut. Thanks.
Deputy Burton.
Thank you, and thank you very much for coming in today. You're very welcome. On page 3 of the Department of Finance submission there, you say the bill is overriding or abrogating vested private property rights. Constitutionally, this can only be done in a proportionate manner and where justified by the exigencies of the common good. And then, after consulting with the Office of the Attorney General, the interference proposed by the bill is disproportionate and therefore unconstitutional. So essentially, there seems so far on balance to be a complete clash of views between the committee here and yourselves, in the sense that your view of the vested private property rights that are under discussion in this context, which are the private property rights and assets of the funds, are entirely, from everything I've heard today, but correct me if I'm wrong, are entirely superior to the rights of the owners or borrowers of the mortgages which are being purchased by the funds. That's my reading of that. Now, what I would just like to ask you is, you have obviously carried out some fairly detailed work, I would say, both of you, or both institutions. in relation to the funds. So what I'd like to ask you is, you know, do you have any of those studies of the funds that you could make available, which if we could read them, perhaps might give us a better insight into why today you are batting so heavily on the fund side and all of the supporting documentation equally? I mean, would it be possible? I'm sure you've carried out some kind of assessments of the funds who are buying in to Irish financial institutions, securitising debt and so on, and that in terms, say, of the bank's oversight and the department's oversight, I'm sure you've broadly had a look at the status of these funds and come to a view that they can properly buy the assets of Irish financial institutions. What I then want to ask you is, you know, when you're doing due diligence on anything, as far as I understand it, and Kieran can correct me if I'm wrong, you have to look at what's happening all the way around in the transaction. So I just want to know, assuming you've done the work on the funds, what kind of work have you done in terms of assessing the economic impact of the actions of the funds in terms of the distressed mortgage holders or the NPLs, in the sense that, as you said earlier in the discussion, I don't want to go back over all the ground, that a lot of these people have restructured mortgages and they're paying them. So in that sense, for a fund which is likely, and you could refresh your memories on this, they may be buying at a discount of anywhere from 30 cent in the euro to 60 cent in the euro, and I'm sure again you know those figures for these particular acquisitions. Can you tell us what work you did to look at the profile of the mortgage holders who are judged to be non-performing, even where they've been restructured and are paying? I think that's the crux of what is the dispute between ourselves on the committee and yourselves, that we can't fully understand your perspective on this.
Okay, well maybe I'll start and the Central Bank can chime in. Thank you, Deputy, for your questions. I mean, firstly, just as to the constitutionality point, which I think was the first kind of question you asked, I mean, obviously we consulted with the Office of the Attorney General, and it was on foot of that you know, we came to a view that the bill is disproportionate and likely, therefore, unconstitutional. So, I mean, the sale of mortgages currently is done with the consent of the owner. The consent is effectively irrevocably given pursuant to the mortgage contract when the mortgage contract is entered into. That tends to be what happens currently, as you know. So when you go to take out your mortgage, you sign the contract, and in the terms and conditions it says that the mortgage can be sold on. Now, the extent to which property rights can be interfered with is, you know, in our view, dependent on what is proportionate. So essentially, the extent to which the interference is justified and necessary. There is a justification to interfere with such rights to prevent sale of a family home, for example, you know, where the home is being sold out from, you know, under the spouse without their consent, you know, that already exists in law, that this can you know, prevent the family home. So
you're saying if they were married to the bank, we could have a legal we could have a legal proportionate right, but as they're not married to a bank, they're likely married to another human being. That doesn't exist.
I suppose the point I would make is that the mortgage is owned by the bank, not by the person who took it out. But
well, you talked in terms of spouses, if I recall.
Indeed, but I think what I'm trying to say, maybe not very eloquently, as your good self, is that you can interfere with property rights so long as they're proportionate. But there is a question as to whether this bill is proportionate or not. In our view, it isn't. According to Deputy Doherty and others, it is. On the issue of the analysis that we've carried out in relation to this bill, I mean, I would obviously make the point this is not our bill. So, in a sense, it has been brought forward by Deputy Doherty. So, we haven't done extensive research in relation to this bill because we never intended to legislate.
My question was about whether you did extensive research in relation to the fund's acquisitions of the assets, because that obviously has national economic implications.
Well, as I say, to finish the point, we haven't done extensive analysis in relation to this bill. We have sought to try and respond to the issues that have been raised in the bill in the last number of weeks when we were asked to appear before the committee. On the wider issue you ask around funds, I don't know, Des, do you want to say something about that?
We have information around the composition of portfolios that are sold, and we have information around the pricing, and I think it was Senator Horgan mentioned some pricing in relation to the AIB transaction, 30 cents in the euro, and I'm not necessarily sure that's correct, although I did see the media reference to it. But
one reads these things in the papers.
Absolutely, Deputy. But I think what the bank did say in that case was that, or certainly brokers commenting on that particular transaction, said it was P&L neutral and it resulted in a 0.25 percentage point increase to capital, so capital accretive. But we have a lot of commercially sensitive information, but I'm just not sure how much of that I could share. It's the bank's information at the end of the day. I'm just trying to think if is there any way I could maybe aggregate the information or try and help the committee by providing some kind of analysis. So maybe if it's okay, Chair, I might take that away and think about that as to what we could usefully do. But we'll maybe have a think about that, if that's okay.
Yes. Okay.
In terms of the profile of the accounts that are held by banks and the non-banks, we publish quarterly information on that. So those that are have no arrears, those that have arrears, those that are in arrears for greater than 90 days, and those that are in arrears for greater than 720 days, and that's split between bank and non-bank. We do a lot of work in terms of on mortgages, both within the banks and the non-banks. Most recently, we published the work of the CCMA review, the Code of Conduct and Mortgage Arrears review, in the second half of last year, and that was based on our work in the non-banks. And we can talk more about that if it's helpful. And clearly, we will continue to do more work in terms of the intrusive supervision that we undertake into the future, and we will continue to publish the data in terms of what's happening in the system, and obviously keep under review our ability to publish our findings from the work that we do on an ongoing basis. I don't know, Grania, can you add anything from the CCMA?
From the CCMA perspective, we published a report in October of last year, and as you know, the CCMA is a statutory code that seeks to protect and ensure that the interests of borrowers who are in or facing arrears are protected, and the findings of the CCMA review, there were a number of findings, but the main finding was that for borrowers who do engage with their lenders, be it bank or non-bank, the CCMA is working effectively and as was intended, particularly in relation to the sales of loans by regulated lenders to, at the time, were unregulated loan owners. The data, I guess, contained in the CCMA report showed that there, and this has been mentioned a few times today already, that there was 110,000 restructures, of which 87% of borrowers are meeting the terms of their arrangements and continue to do so. The report also found that banks and non-banks continue to put arrangements in place and continue to engage with the borrowers right throughout their relationship with them. We also found that banks and non-banks have frameworks in place that support the borrowers in terms of transparent, open engagement and communication with the borrowers. And we found that the existing arrangements are honoured when a loan sale is effected and a portfolio of loans are sold from a regulated bank to a non-bank, where the finding at that point in time in October of last year was that the existing arrangements are and continue to be honoured by the non-bank.
Thank you. And just going back to the constitutional issue, which seems to be the major difference, if you like, between the committee and yourselves, do you accept that there are competing rights in the Constitution and that it's now widely held internationally that shelter is a fundamental human right, and that's recognised in the International Convention on Economic and Social Rights? It's also been recognised in the Constitution and in a series of cases in the courts down the decades. For instance, that the vested private property rights do not always trump public rights, human rights, or, if you like, the social rights of the Irish people. For instance, it may be decided that a road or something like that is a public necessity, and therefore that a compulsory purchase of land may be in order to give effect to the road. I mean, what I'm asking you is, you're telling us about focusing, as it were, on the transactional nature of the sale to the funds. But what you're not telling us is what thoughts or examination have you given to the people whose mortgages are being sold on? I mean, would you agree that precariousness, economic precariousness, is one of the, if you like, great difficulties of this era? Because jobs have become more precarious, people's access to housing, to reasonable renting, to affordable mortgaging, and so on, has just become, not just in Ireland, but globally, possibly partly as a result of securitisation of a lot of financial assets, it has become much more difficult, and it has therefore become one of the fundamental threats to working democracy, that you don't have a situation where there is an appropriate balance between the single individual, family, couple, person who entered into a mortgage and the financial institution with whom they entered in. And I think that's why the committee has focused so frequently on, if you like, some protection of customer rights. And I'm just trying to see, have you any sense of how you could offer to customers who possibly were lent too much money back in the day by banks who were very careless and subsequently went bust? That wasn't the fault very often of the people who took the mortgages, because stuff came in their letterbox saying, hey, you can borrow so much today, and so on. Like that, there is a context and a history to how so many people got into difficulty. So I'm just want to know, do you have something additional to offer? Because for somebody who already feels precarious, because they've been in mortgage difficulty, possibly lost their job, we know that from all the different hearings you've attended and we've attended, and then have struggled to re-establish themselves financially. A lot of the people who are paying are doing that. But is there something that you can offer where you're concerned about the vested private property right, but that you might also show an equal concern for the precarious situation that mortgage holders are finding themselves in, and that instead of improving, unfortunately, seems to be getting worse rather than better?
Well, thank you, Deputy. I mean, obviously, Deputy, we're civil servants, so we're simply trying to give the committee our view on the Constitution as it's currently written, and particularly Article 43 in relation to private property. And I'm sure that it's no surprise to you that private property rights under the Irish Constitution are very rigorous, and I'm sure there have been many debates in this Oireachtas over many decades in relation to whether those property rights are too strong or strong enough. But we're simply trying to give the committee our view on the constitutional provisions as we understand they now exist. I mean, obviously, it's a matter for the Oireachtas if it wishes to propose, or the Oireachtas and the government if it wishes to propose constitutional amendments in relation to shelter.
So, are you suggesting then that, and I mean that's a point of view, that the department's point of view is that property rights trump individual, human, family, personal, social rights, because there is a very wide constitutional view that those rights have a very significant status. We recognise private property rights, but we also recognise human rights in relation to individuals and families and children. I think it's a matter of huge distress to a lot of people at the moment that the number of homeless children is just going up and up, and children are now spending long times in homelessness. And I think one of the reasons why people on the committee feel quite strongly about the bill is that as this is now growing with securitisation of more and more financial assets, that people who end up having to give up their homes as a consequence of these sales, this is what people are terrified about, that they and their children will end up homeless. Now, I do actually think that there is a view in the Constitution around human rights as well as property rights. Well, I know they're there.
Well, again, Deputy, I'm not trying to suggest that one type of right trumps another type of right. And again, I think has been previously said by a number of people, I'm not a constitutional lawyer. We're merely trying to put forward the fact that there are strong property rights in Ireland's written constitution, and that I think that is a consideration that needs to be taken into account in relation to this bill. And I mean, I think that's intended to be helpful to the committee. It's kind of a statement of fact, really. I don't know if the bank wants to say anything.
Yeah, but would you accept Article 2.1? The state recognises, however, that the exercise of the rights mentioned in the foregoing provision in civil society is to be regulated by the principles of social justice. That's Article 2.1. Article 2 also states, the state accordingly may, as occasion requires, delimit by law the exercise of the said rights with a view to reconciling their exercise with the exigencies of the common view. There's a view of property rights that they're absolutely there. I don't think any of us have any problem with that. We want to see the exercise of balance. And as the Department of Finance is tasked with the economic good of Ireland, I'm just saying to you that precariousness in the modern economy, not just in Ireland, is one of the features that would appear to be undermining democracies. Democracy is also an absolute value of our Constitution. So I'm putting it to you that as the Department of Finance, clearly your first brief is the economic, I recognise that, but you also have a brief to look at what is happening to Irish society in terms of the common good. And I'm saying to you, do you have any suggestions to offer? Because the committee would be avid to hear as to how we could balance the rights and reflect and endorse the rights of the individuals whose mortgages are being sold down and who feel even more precarious as a consequence of reading in the papers and also of knowing, because people see a lot of media, that it's likely that these particular funds may well sell on within a time span of 5 to 7 years. I mean, this is like the subprime stuff in the United States. And when it was first talked about in Ireland, people couldn't even believe that it would exist here. But we're looking for a solution that would allow this bill to give a comfort to people who would be affected so that they would be less of the precariat.
Yeah, thank you, Deputy. I mean, I think, and again, with the proviso that we're not constitutional lawyers, I think the important thing here is that any provisions in legislation that relate to vested private property rights need to be proportionate. And we're certainly not convinced that the measures proposed in this bill are proportionate. So I think the proportionality test would be an important issue that would have to be considered in relation to this bill. On the issue of society becoming more precarious, that's obviously a concern. I think that we have been careful when considering this bill not only to think about people who are in mortgage arrears, but also the people who have other people who have mortgages and other people who would like to one day get a mortgage, and all of those people, their particular circumstances could in a variety of ways be described as precarious from time to time, and they also need to be considered in terms of the implications that this bill may have should it be passed. So I think it's important that we don't only think about one category of mortgage holder, but when we're thinking about a piece of legislation as potentially radical as this, we would think about the implications for all categories of mortgage holder.
Mr. Burton, if I just could put some questions to you. I don't know how Deputy Doherty feels about this, but the media coverage of the bill and the statements from all of the usual suspects rained heavily on him this morning, and the language used, I think, could equate to an effort being made to scaremonger among getting that message out of banks not being able to raise money, interest rates going up, the next mortgage applicant not being able to apply or get a fair deal. I think it was absolutely horrendous, actually, the coverage, and unnecessary. We were here today to listen to what the Central Bank and what the Department had to say in relation to Deputy Doherty's bill, and to learn from what you had to say to determine if we could in any way move the bill forward with the cooperation of the Department. But quite frankly, I think that both the Central Bank and the Department of Finance have a very set view on this. So rather than get lost in the legislation that's before us, let's look at what that legislation is trying to achieve. So when you look at the right and the might of the bank, that's what we're up against here, it would appear. Do you think that a person with a loan has the right to know where that loan sits? Who owns that loan? Is that a right that they should know who they're dealing with, that they should know that loan owner?
Yes, the provisions of the central bank's codes require that obviously you know who you've taken your loan out initially as a borrower, and if the lender of that loan sells that loan on to anybody else, the lender is required to tell the borrower at least 2 months in advance of who they're selling the loan to, the name and address of that party, and equally if that entity, if the loan is going to be serviced by another party, they give you the contact details of the servicing as well. So that's very clear.
The structure of recent sales, you know, they have quite a hierarchy of companies. There's the first purchaser, then there's the beneficiary, after quite a confusing structure in terms of where the loan and the benefits of that loan finally end up. We don't know. We don't know. The borrower doesn't know.
So we touched on that a little earlier. It is critically important that the borrower knows who's they're engaging with, who they deal with if they have queries or they want to discuss their particular arrangements, or they need to engage in terms of their particular circumstance if they're in difficulty, and that is absolutely a requirement.
The note at the end of it.
So I mean, so there is. I do appreciate the sentiment there, and it is the nature of the, not just the financial system, the corporate system, that beneficial owners often are far away from the company that someone might be dealing with, and that's
fine. But I want to know who they are. So I'm putting myself in the position where I have the loan with the bank. For some reason, it's gone to another party, so I know who they are in Ireland, I know who I have to deal with, but I don't know who owns the note at the end of it. I don't know the reach of all of this, and I think that the Irish people have a right to know that. And you might say it's the construct that these financial, you know, the banks and so on, and those in the world of finance put on these purchases. But I would say, well, what weighs correctly here? Is it the borrower in the first instance should know, or are we prepared to allow the banks to hide behind all of these entities? And I would say it's the borrower. I want to know who ultimately I'm dealing with.
So again, I appreciate the thrust of the questioning. There is, the reality of the situation is what it is, and I can appreciate what you're saying. This is why we have been focused on ensuring that it's clear who the borrower has to deal with, and the requirements on the entity that the borrower is dealing with are the same regardless of whether it's a bank or non-bank. So the regulatory requirements, the things they have to comply with, the instruction. Now, I do genuinely understand the thrust of it. As much as we can, we have tried to make it clear the owner. But then, who's the owner of that a vehicle, and who's the owner of that vehicle? And I mean, who are the shareholders in the banks? How does that all kind of come through? It's part of how the system operates.
Yeah, but should we not know all of that? Like, it's a great mystery to the individual who is not well versed in the language of the world of finance. And there's further mystery then added to it, and secrecy, by virtue of the fact that someone that is benefiting from their loan in terms of the profitability that's brought about by the sale of the loans is not known to them. So, and you might say, well, that's the way it happens in the world of finance. Well, I want to tell you that I think we should look at what happens in the world of the individual and the rights of that individual.
What we're very focused on is making sure that regardless of the ownership structure, that the entity that's engaging with the borrower is subject to the same requirements, the same regulation, the same codes, regardless of ownership.
Essentially, we're never going to know. That's really what you're saying. We're going to get just enough information but we're not going to get all of the information. That's the nature of what we're into here.
So, I mean,
it's just yes or no.
Well, I mean, the legislation that was passed last year will give more information about an entity that's located, registered and regulated in Ireland.
So
how far you can get beyond that?
We don't know and we won't know. So then you go to the right of the person to speak to the fund or the representative of the fund, and the right of that individual not to be treated as a second-class citizen when they're dealing with that company. So if you take the agents of these funds that are here, regulated and so on, I have to tell you, both the central bank and the department, that they have a history of treating people very badly. You cannot get in touch with them directly by phone. If you're talking to one individual today, it could be some other individual tomorrow. You repeat the same story to them over and over and over again, and you express to them the desire to have your rights fulfilled and your information given, and you're stalled constantly in that process, to the extent that people now have to get financial advisors, or they have to get solicitors, or they have to come to people like me and other members of this House and Senate, and they cannot deal with them. And what infuriates me is you give, what your side of the story is, as it were, without acknowledging that there's a real problem here. They cannot paper over it anymore. So when an individual writes to the central bank, you won't take up an individual case, you won't comment on it. When they write to the department, well, they're only, policy, they're driven by policy and stuff. So who is going to stand up for the customer and the rights of that customer?
So we were asked to submit a view and asked to come here today to give an opinion. We have given our view. I personally think we've been balanced in that, in terms of trying to look at the issue in the round, particularly around looking at the overall protections that are in place for consumers, and I'm talking about those that are owner-occupiers primarily, in terms of that's how the coverage of the CCMA. In terms of information that's provided to us, I personally have read all the submissions that you've sent in to the central bank, and we very much encourage and welcome those submissions. When we have submissions from individuals, they are form part of our approach to ongoing supervision. We will continue to do that. There are other protections in the state for individuals, including the Ombudsman, and we will continue to engage with them in terms of making sure that systemic issues that are dealt with.
But the central bank is the go-to entity for a customer who wants to make a complaint. And I have seen more written and said about the rights of the banks than I have seen written or said about the right of the consumer. So that concerns me greatly.
With the greatest of respect, what I've tried to outline, and if I haven't done it successfully, then I'm happy to try again and continue to try to do so, is the amount of effort and work that we've put in to ensure that all borrowers are protected regardless of circumstance. The approach that we've taken through all arms of the central bank to make sure that those borrowers that were in distress, and a very, very large number of them in distress, are protected, are being dealt with in a humane fashion, their individual circumstances are being taken account of, that they are offered restructures to deal with those individual circumstances, and they're being put on a sustainable path. And that hasn't been possible for every customer, but there are more than 110,000 accounts that have been restructured, owner-occupier mortgages that have been restructured. There are still, unfortunately, and it is desperately unfortunate, that some borrowers who are still in deep arrears and that continue to need to work through the problem.
Yesterday I met a woman, not from my own constituency, and she had a file that thick with her, well versed in the world of finance, and she told me in regard to one of the main banks that she had failed to get to anyone within the bank to influence them in the context of a decision in her case, and that she was now in her 10th year. Now, I come across an awful lot of those cases, and some people might quickly, ignore that and say, well, they're cranks or they're mad or whatever they might say, just to discredit the individual. But the number of cases that I'm coming across now are actually growing, and hence the purpose of Deputy Doherty's bill. And that's not the only bill. There was a number of other bills, all trying to do the same thing, all responding to the cry from people around the country for further protection. So if the protection was as good as what you describe, then these bills wouldn't be coming forward. They just wouldn't. And the answer is always the same. Now, I want to move to the right to negotiate with the bank, because this is critical, I think, in the context of Deputy Doherty's bill. The banks are not engaging in the way that they are pretending. They're just not. There's too many people telling us the same story about the lack of engagement for it to be true that they are engaging. So they're not engaging the way they should. What is wrong with forcing every bank to work out a sustainable position for the loans where they can? And in the context of that right of an individual to work out the loan, why is it that the banks don't do that? They don't use the full extent of the options that they have.
So there are considerable protections and requirements in place for more so for owner-occupiers than investment properties, and certainly some of the correspondence that I've seen has related more to investment and buy-to-lets than owner-occupiers. But there are considerable protections. There are requirements in place for banks to be engaging with their borrowers. The evidence is across the system that they are. There are also lots of other protections and supports available. We can see an increasing usage of the insolvency service and personal insolvency arrangements that are being put in place to support borrowers who are in distress, and indeed in the vast majority of instances keep them in their homes.
And I'm suggesting to you that there is, in my opinion, quite a large number of people who are finding it extremely difficult to engage with the banks. They don't return phone calls, as I said earlier on. They take forever to deal with issues. They wear down the individual so that at the end of this, the individual is beaten. And if an individual is beaten by the system, having tried it, their family is beaten. It has terrible social consequences.
And I do genuinely understand the pain and distress associated with this. What I would urge is that they would continue to write to you and other representatives, and you would continue to write to us, and we will continue to engage on the evidence that is put in front of us in terms of problems in the banks. I don't see how that's solved by this bill.
What I'm trying to do is I'm trying to bring to your attention the purpose, the reason for the bill being here, the reasons for the other bills that are coming here before us, is because people in this House are being approached by individuals who are telling us this story. And you hear it. You hear the stress. You witness them crying with their children in courts all over the country in the context of repossession. And Deputy Doherty's response to it is this bill. And your response to the Department of Finance as well is that we're doing all we can, that the whole world will cave in if we do anything to upset the banks. And bills like this then, they just get left there because when all fruit fails, bring in the Constitution.
So
that'll surely scuttle the bill.
So I made no reference to the Constitution in
I didn't say you did.
Statement.
I'm saying to the Department of Finance. And that's what's going on here. I mean, it's amazing how quickly, as Mr. Draghi wrote to us, you know, they jump out of their skin over there in order to protect the banks. And they write to committees like this. But when we're asking to protect the citizens of the state against a banking system that brought us to our knees, you get no response whatsoever. But there's loads of response and opinions when they want to undermine the efforts of this House to bring about a balanced situation for people who are desperate in their own lives, who have been before the courts and bullied and intimidated by banks and the people that represent them. And I'm saying this to you, Mr. Tobin, in particular, because in your opening remark to one of the members here, you said that you're here to speak truth to power. Well, you know what? I think that I'm speaking truth to power on behalf of the people that I represent, because it would seem to me that it is the banks have all the cards and they're dictating what happens. And what the citizen is looking for is some tilt in that balance that says, you know what, we know you're out there and we know your pain and we're actually going to do just something about it. And I don't think that this bill that Deputy Doherty is bringing forward, I don't think the world is going to fall in if a version of that were to pass in this House.
Well, I mean, clearly, Chairman, that is your view. I mean, we have tried to set out in a clear way what we feel the likely implications of this particular piece of legislation are. Clearly, we disagree. From my vantage point, there are a lot of borrower protections in place in Ireland for borrowers, and there are very, very low levels of repossession in Ireland relative to many other European countries. I have no doubt there are people, as you describe, who are in mortgage difficulties and are experiencing extreme hardship, you know, I think that, you know, that is a terrible fact. But I think over the last number of years there have been concerted efforts by various governments to try and improve the situation. And I'm sure there is still more that can be done. And we're certainly open to ideas, by all means. But that, unfortunately, does not mean that we can come in here and tell you that this is a great piece of legislation when we think there are very substantial flaws with it.
Yeah, no, I accept that. But I'm also asking you to accept that what you're telling us here, in the context of statistics maybe, or the overall figures, is not telling us the full story. That there is another side to this, a side that I and other members of this committee have described to you in the course of this meeting and other meetings. And we're simply asking that it be recognised. Now, Deputy Burton made a point about the Constitution and in relation to the citizens of the state. Well, by ignoring the plight of those that are so marginalised by this state, you're actually undermining the state and its institutions. And someone has to reach out to ensure that that body of people are assisted and helped by legislation or by regulation, wherever it might be, to have a life in spite of the fact that they may have a bad mortgage. Because when you look at the history of it, you know, and everyone, you all know this, they went into the bank for a loan of 100,000, they came out with 200 and 1 or 2 cars. Like, in the name of God, you can't say that it's the people who were at fault. They were all at fault. So was the central bank, so was the Department of Finance, and so were we. But the effort being made by us to ensure that this is reasoned out and that the people who want to pay, not the won't payers, but the people who want to pay, will get a fair deal in the bank before it goes anywhere. But the bank, for a shortcut, with the sanction of this House here, is able to dispose overnight of the loans. And I'm simply asking, in the context of Deputy Doherty's bill, that the Department of Finance would look at the social consequences of this, not in a silo on just the financial institutions, the social consequences of homelessness, kids on the street, families in hotels, 140,000 people on our housing list, buy-to-lets being sold and the people being asked to leave. The banks are asking them to leave.
Well, again, Deputy Chairman, I mean, there's a lot that you've said there that I agree with. But, you know, just in my opinion, I think through the financial crisis, and Ireland had a terrible financial crisis, the state acted in many ways very responsibly to try and prevent large-scale repossessions, and there was a lot of forbearance shown to people in mortgage difficulties. And I personally think that was hugely important in terms of keeping our society together over a very difficult time. But again, I would say that while we're very open to suggestions and ideas, we can only give you an honest opinion of our view of this particular piece of legislation, because that's what we've been asked to do. Obviously, some of the matters you raise are policy matters for the government of the day, and we serve the government of the day, whoever the political party is. But
do you serve us here?
Well, I would like to think that we serve the government and the Oireachtas, and certainly we have, through our best endeavours, tried to assist in the passage of a number of pieces of private members' legislation. But the government must agree to support the legislation, and you know, we must also give an honest view of what we feel the potential implications of the proposed legislation is. But you know, we're very open to suggestions and ideas, and you know, my experience of dealing with the central bank is that they are also very open to looking at.
You're all the one club. Why would you club another member there? You know? This is what people say. You know what I mean? You're ignoring the public, ignoring the plight of people, and maybe it's up to the committee here to have a full day session with all of the affected people, and give a voice to everything that's happening out there on both sides of this argument. And maybe I put that to members at our next meeting. Can I just ask, and because I was interested in this, I want to understand it. The central bank, the ECB gave us the money. You were talking about it earlier on, Mr. Sibley. The ECB, it was money from the ECB rather that helped us out in the crash.
So there was a combination of financing. 140 billion of that was from the euro system, so that effectively comes through the ECB. There was also funding provided primarily, but not exclusively, to Anglo-Irish Bank through emergency liquidity assistance.
Where did that come from?
Well, that was effectively from the Central Bank of Ireland.
But the money from Europe, that came through you central bank, was it, into the banks?
To be honest, I'm not entirely sure based on the arrangements that were in place at that time, but it was effectively through, I think it would have come through us, but I can confirm that. But it would have been Eurosystem funded,
Yeah.
as opposed to on the
And for that money then, was that backed up by the loans in the bank? In other words, as security for that, did you?
Yes, but both the funding from the Eurosystem, and I referred earlier to 40% of that was backed by mortgages.
Yeah.
The rest would have been backed by other collateral, which would have included other lending, government bonds and the like.
Right.
The emergency liquidity assistance is granted where the quality of the collateral isn't high enough for the Eurosystem funding, and so it would have been other types of collateral, and including ultimately the promissory note.
So if these mortgages were put up against this loan that was coming from who was selling the mortgages then?
So
is it the central bank or is it the group of banks?
So it's effectively transferred to other. Maybe Vaz, you want to come in on this?
So some of these would be securitizations, where your question was who is selling the mortgages, right? So the bank would have sold the mortgages to an SPV that then would have issued securities that would be retained by the bank, and then these securities are then pledged as collateral with the Eurosystem.
So do you benefit from these sales then? When the bank goes through this sale to a fund, you have an interest in it because there are mortgages there that you have put up as collateral against the euro money.
So, I mean, the Irish banking system had acute liquidity challenges at that time. It posted collateral. It needed to do some engineering in order to post that collateral with the ECB. That resulted in Eurosystem funding being provided to the banks for them to maintain liquidity and be able to continue to honour deposits, for example. They would pay interest on those loans in the same way they would be interest paid on any loan. So they were borrowing from the Eurosystem. They would pay interest on those loans. But I would differentiate that entirely from private transactions that we've added to private transactions.
No, but if you have mortgages as collateral, do you then, if those mortgages are sold by a bank, do you have to release those mortgages?
Well, the bank would have to pay back the borrowing in order to release the collateral in order to be able to sell it.
So the vulture fund, let's say, is paying Bank A for a number of mortgages, right? Mm-hmm. So let's say it's 200, and you have 100 of those mortgages.
So we don't. So we, as in the central bank or the Eurosystem. So that's a historical point in time.
It's what?
It's an historical point in time. So at the peak, at the height of the crisis, there was 140 billion of Eurosystem funding. That is sorry.
Is it today? 75 billion.
Less than 5.
Less than 5 billion. Okay.
So sorry, what's less than 5 billion?
So there's 140 was effectively borrowed through the ECB.
Yeah.
There's now less than 5 billion. And are you including the 30 billion of the promissory note at Anglo in that 140? The ELA?
I think it's outside that. So that was the Eurosystem funding.
It's not quite.
The ELA would have been on top of that.
I wouldn't put that now in the same category.
No, it's completely different. So it is completely different.
I don't know, I would be saying 110 now. I wouldn't be including Anglo now in that. Wouldn't be kind of like with there now, with due respect.
Sorry, I can check the figures, but I think...
No, but I'm just saying. Sorry, I'm digressing. It's a technical point, but
so there's no release of mortgages in that sense?
No, there's no... I mean, there's no No. I mean, if it was the case that there was still 140 billion borrowed, and there was collateral posted against that, then that would have to be repaid before.
So what the banks have done, they've paid you
the
euro that they've paid back.
The banking system between at the height of crisis, immediately before, compared to today, is so much smaller. So there's been a huge amount of deleveraging of balance sheets, and as part of that, the euro system borrowing has been almost entirely repaid.
The interbank market, it's not.
So yeah, pre-crisis, a lot of the lending that we've talked about, and the irresponsible lending that we've talked about, was funded through secured and unsecured borrowings in the wholesale markets, when there's kind of very loose or ample liquidity. When that started drying up in 2007, 2008, the banks simply couldn't fund the assets that were on their balance sheets. So that's where you got into a kind of really sharp liquidity squeeze. And they had to borrow from the euro system. The euro system criteria for lending money was considerably expanded, which gave not just the Irish banks, but certainly the Irish banks, time to put themselves on a more sustainable, more secure, more resilient footing. Much of that work has been done. There's still a little bit of it left to do, I would say, but much of it's been done.
Would you be able to give us some?
Yeah, I have a lovely graph on this. It's on our website, so you can see the whole ELA funding, and it's broken out. I'll send you that.
Yeah.
Yeah, it's nice.
And if you have any further information, Mr. Sibley, sure, you can add it.
Sure.
Can I ask?
Yeah.
In terms of the arrangements that are provided, selling to the fund, from my perspective, should be a measure of last resort. The banks should have the skill sets within the banks themselves to sort out the loans. And there should be responsibilities to the banks. They did irresponsible lending, and the ordinary person looking out there, as a mortgage holder, is saying they can get off the hook for their mistakes by basically flogging the loans onto a fund. It's gone, not their problem anymore. And there would be a view out there amongst a lot of the mortgage holders that the banks themselves didn't do enough in terms of putting arrangements in place for hard-pressed mortgage holders. So I suppose the question I'm asking really is, in terms of solutions like, instead of mortgages extending mortgages maybe to, some other jurisdictions which they go for 30 or 40-year mortgages, to put measures in place to keep people in their homes, to restructure the balance sheet to the banks so that they're not selling on to the fund, right? And people have an attachment to their individual institution. They're Irish-based, you can say their shareholding changes, but there is that degree of familiarity is the word. So I suppose it's really within your domain, Mr. Sibley. In terms of alternative, more long-term arrangements being put in place to that the banks take responsibility for their, I suppose, reckless lending over a period of time. And it was reckless. Some of it, many of the people who would come to us ended up with mortgages they should never have got. The system and, the rules have come in. People would say there are elements of the rules they find draconian now. However, there are elements of it that are working. It's not perfect, but there are elements that are working. So, Mr. Sibley, have you looked at ways of, and the worry is for the ordinary person outside there, they're basically saying that selling off to the fund is effectively a get-out clause for the reckless lending of the individual banks. That they don't have to take that level of responsibility to deal with loans they gave out that they should never have given to people. And then someone is the loans are being sold on to a fund, and they obviously have a major nervousness that they could be sold on again and again and again, and suddenly they have no idea who they're dealing with. So you understand, so I'm trying to get to a point where, going back to the Chairman's original point, how do we improve the lot for the person who's hard pressed? That it's dealt with by the institution who made that loan to them day one. That they take responsibility for actions, because the individual borrower, they're required to fulfil their requirements under the terms of the loan. And we're now coming to a point where the banks are getting their second wind, but for many of these people we're dealing with, they're not. So you understand, my point is, have you looked at ways of restructuring loans to be much longer period of time, and that the banks themselves will come up with more imaginative ways rather than just selling them on to funds?
So there's quite a lot in the question, and I mean ultimately,
I'm trying to be constructive.
No, and I understand that, and ultimately there will be different views on whether they have done enough or not. Like if one thinks about where we were, so. In 2000,
unfortunately, based on past, but tracker.
If you let me finish. Based on where we were, to say that at the height in terms of the number of people that were in distress, the number of accounts that are in difficulty, that's 2012, 2013, and where we are today, then there has been a huge amount of effort, both for mortgage holders, but also for SMEs. Now, some might not like the outcome, some might not like how that engagement has worked. But in terms of what we can see is that there's been a huge amount of restructuring that has been done. So if we look at the owner-occupier mortgage accounts that are held within the banks, about 1 in 6 of those is restructured. About 9 out of 10 of those restructures are meeting the terms of that restructure. Those restructures, when we started in, say, 2012-13, a lot of those restructures would have been interest only or part payment or just very temporary forbearance. The dial changed on that because of the engagement of the central bank, because of the engagement of the likes of here and other state agencies, to make sure that the solutions that were being put in place to help borrowers stay in their homes were addressing the underlying issue. So short-term forbearance to maybe give the borrower a chance to get back on their feet, longer-term forbearance, restructure, split mortgages, extending the terms, arrears capitalisations, economic concessions. All of these have been put in place. And there is lots of evidence of it happening. Now we do still have a circumstance where too many, unfortunately, borrowers are still in distress. And there is a question which I think is legitimate and is legitimately being asked by this committee in Oireachtas as to what's the approach to dealing with those borrowers that are still in distress.
Correct.
Many of them very, very deep in distress. And how can that be addressed? Now there are potential solutions in there. I look at what's coming out of the insolvency service as being, I'm sure, a very difficult process to go through, but there's a lot of work being put in by the Oireachtas in terms of setting that up and then refining it to make sure it's working effectively, and more people are using that. But the most important thing is to try for borrowers in distress, notwithstanding, I appreciate the Chair's comments on this, to be engaging with their lender, whether they're bank or a non-bank, because they are required to engage. They're required to consider the individual circumstances of the borrower, and they're required to try and put in arrangements that work for that individual circumstance. And we will always listen to evidence, look at evidence where that isn't happening, because that's what a bank or a non-bank is required to do.
And the 30 or 40-year mortgages, what's your view on them? Well, you would certainly have someone who would say that's in a 15-year mortgage cannot meet the requirements if you spread it out over a much longer period. And I know that it becomes intergenerational then.
So they are relatively prominent, the term extensions. Not quite as prominent as capitalisations or splits, but they are relatively prominent and being used. Now, the danger with them is that you end up with putting a borrower in a circumstance where their overall cost of credit is going up because they're paying interest for longer, and if they're being pushed into retirement, beyond retirement, then how are they going to repay in retirement when their circumstances are probably disimproving financially. So that absolutely is a valid and viable solution, but it needs to be tailored and considering the individual's circumstances.
So you're not adverse to them?
Absolutely not, and they're happening. But I would be concerned if all I saw was term extensions, because that would indicate that the individual borrower's circumstance wasn't being taken into account.
Thank you.
Thank you very much. Deputy Doherty, do you want to say anything to wind up the...
Is that okay? Can I just ask a couple of questions to finish up?
You can, yeah. You can wind it up then.
My
please.
apologies, I had to take something in the Dáil chamber for a few minutes. But I'll look back at the transcripts in relation to the piece I missed. I just want to go over some stuff, if that's okay. Can I, because we didn't get it, we were talking about the broad brush, so the Central Bank's submission, particularly in relation to Appendix 3, I want to welcome the comments that I've made in relation to this here, because this obviously goes into the detail of some of the definitions and also the issue in relation to enforcement and the regulations, which is helpful as we continue to look at this legislation. So I just want to welcome that. Mr. Sibley, you said, and there's been a lot of commentary in relation to the impact of this bill in terms of financial stability. You mentioned earlier on that when I outlined that the intention of the bill was not to deal with the issues of securitisation or impact the issue of securitisation, ECB collateral, and a number of those other issues that you identified. You said that would go a large way to addressing the concerns of the central bank. In relation to the other parts that have been set out in Appendix 3, which deals with some of the definitions, is there anything else, in your view, outside of the fact that, like, the core part of this bill is to prevent a borrower transferring a loan, a direct transfer of a loan to a third party, a vulture fund or otherwise, without the consent? But is there anything else outside of that, if the committee so determines, based on their own legal advice and the committee's view, that we pursue this legislation? Is there anything else that you would like to add, given the point I made earlier on that it would be my clear intention to have that area that was of greatest concern to the central bank accept from the legislation?
Yes, so certainly that's an area that would be of very significant concern for us. I mean, we do have a broader concern around the functioning of the market for all. And while currently the retail banks in Ireland, certainly the domestically owned ones, are largely deposit funded, and an inability or a restriction in terms of ability to raise funding, not just from a Eurosystem perspective, but also a potential restriction about being able to exit the market for new entrants, I think is something to bear in mind. But we've talked about that already. I just wanted to make sure that there was no misunderstanding. There are concerns that we have around, from a financial stability perspective, as to what would happen in the event that a bank were to get into difficulty, how this bill would interplay with resolution, how it would interplay with what would happen after a resolution event, or if we're dealing with a firm that was likely to fail. And I appreciate there is some mention of that in the legislation. And then there would have some maybe some concerns around how that would be dealt, how we would deal with that particular circumstance around the financial distress. Maybe Vaz or Gron, you want to come in with some specifics?
Nothing beyond that. So there's a comment here about looking at this in the context of the BRRD, which would be setting out kind of updated both from a resolution and recovery perspective, but it's something that could be looked at next to the new BRRD regulation. Yeah.
Okay.
The last point, again, it's been made a number of occasions in time here today, but actually that we fully support a full impact assessment of the consequences or indeed unintended consequences of the bill. I think that's a sensible measure.
And can I say that if the bill were, and again, I'm only one member of the committee, I'm the sponsor of the bill, but if the bill were to not exempt the issues that I've talked about that I intended, and we have the bill was crafted in a way not to impact them, but that needs to be clarified. Then it can be done so. But why would there be need to be a wider impact study in that regard? I can understand if it was the intention to actually impact on securitisation or ECB collateral or different ways that the banks can secure finance in terms of covered bonds and so on, that there would be a wider impact. But this bill is straight up, straight down. It is, you can't sell to a vulture fund unless you, or indeed any other bank. And I hear Mr. Sibley's comment, which is a very sensible one in terms of a bank exit, and that needs to be dealt with. But where do you see the wider impacts then in relation to the legislation if those other areas are exempt?
So I guess it has to be bottomed out as to whether it adds significant value for or additional protections for the consumers, and we've heard a lot here today around the impact and the perception that consumers have of vulture funds or non-bank borrowers, and I think it might be beneficial to do some assessment as to whether there were any unintended consequences for consumers arising from this bill.
I asked a question earlier on, I just want to tease it out. If the SPV vehicle that bought the 6,000 loans from Permanent TSB, if they decided tomorrow morning that they were notifying their customers that they were going to increase their standard variable rates by 2.5%, what could the central bank do?
So we don't have responsibility around interest rate setting for. So I appreciate the risk that you raise. Now we aren't seeing evidence of that today. We've had this discussion before. No. I had this discussion with Deputy McGrath around his other bill that, around variable rate mortgages. So we haven't seen that. No. There is a question around unfair contracts and whether there would be abuse of contract in that circumstance. Clearly, we would be very engaged if that was happening. We haven't seen it today.
But the banks have the power, like the banks and the funds would have the power.
So I mean, subject to the terms of the mortgage, then if it's what would typically be called a standard variable rate mortgage, then
But have you ever seen a standard variable rate mortgage that limited the ability of the bank?
No, so I was agreeing with you. So yeah. I was agreeing with you.
And see, this is the point when we talk about regulation and the code of conduct and all the rest. I accept they're there. I accept the two entities are regulated exactly the same way. Well, SPVs may exempt from the regulation, but the issue is AIB likely to put up my standard variable rate by 2.5%, or is who's the most likely to do that if that was to happen, and that's where the risk appears? I'm hearing, Mr. Sibley, now that one of the funds, and you may clarify this or not, that one of the funds who bought a certain amount of buy-to-lets from one of the banks I won't mention which it is, are now issuing letters saying that they're asking for the arrears to be paid within 30 days, and if the arrears aren't paid within 30 days, they're appointing receivers. And this is the standard practice of the vulture fund now?
So I'm aware of the parliamentary question you've submitted on it. It's very difficult for us to get into the specifics here. We will certainly respond on the specifics, and we're engaged with that particular entity in relation to what's happening there.
But see, okay, I appreciate what you're saying, but we've got a sale by a main bank in the state to a vulture fund. Buy-to-let mortgages that were in arrears, obviously. And the vulture fund, and the bank could do this in the morning as well. The bank could have done exactly the same thing, but the bank hasn't done it. But the vulture fund, I understand, is doing it. And that is that they contractually have the right to say, settle your arrears within 30 days, or we appoint a receiver over your properties. And that's why people do not want their loans sold to vulture funds.
So I think it is important to distinguish between the owner-occupiers and the buy-to-lets in terms of the level of protections that are there. Yeah. Clearly, we're talking about investment properties here. that right to appoint receivers, rent receivers certainly, is in a lot of the bank contracts and has been exercised by the banks on rental property already to quite significant amounts. So that's not, I mean, can argue that the wrongs and the rights of it, but that is not in all banks, but that ability to appoint a rent receiver is stitched into it, certainly.
Yeah.
The majority of the buy-to-let lending.
Familiar with that, and indeed, obviously, a rent receiver in a place where a landlord isn't passing on, you know, that's completely legitimate. That isn't the issue here. This is nearly what you would call a strategic default, where you basically call in all of the arrears within 30 days, which is next to impossible for somebody who's trying to manage through an arrangement. These are individuals who are making payments, but they're saying, everything in 30 days, arrears cleared up in 30 days, and we appoint the receiver. When they appoint the receiver, obviously they don't have to go through the court system.
So, again, I don't know the individual circumstance. One would expect that if a borrower was engaged, was up to date in terms of the restructuring arrangement that they had agreed with the lender, that wouldn't be the case. But I don't know the specific circumstance that you refer to, and we obviously will look.
I asked you earlier on in relation to the April report by the Central Bank, which identified that those in long-term arrears of 2 years or more, that over 50% of them are likely to lose possession of their homes, either through voluntary surrender or repossession. Does the Central Bank still hold to those figures?
So what we can see is there are I think it's, sorry, I'm just checking. Well over 20,000 accounts that are more than 2 years past due, and a group of those, a significant portion of those, are going through the legal process now. How that plays through, I don't know. Certainly at the moment, when we look at what's coming through the court system, not all cases, accounts that go through the court system, in fact less than half, end up in a court order. Some are withdrawn, some are restructured, some are paid pretty much on the steps of the court. But one can see that if you're in that deep arrears, that the potential for a loss of ownership is there. And I mean, as I've said a number of times today, and also in other committee appearances, the most important thing is to try and engage with the supports that are there, engage with the lender, use the likes of both the advice and the practical solutions that possibly in place through the personal insolvency service. To try and keep that to a minimum. But at the end of the day, and this is a harsh thing to say, but if we want a secured lending system, which is I think what we want in terms of some of the other discussions we've had here, then that security has to mean something at the end of the day.
Mr. Sibley, final question to you, and I've got one to two to the department, but final question to you. Do you believe that a loan which is performing and who's not fallen into arrears, do you believe that there should be protection for that type of loan that shouldn't be allowed to be sold on without somebody's consent? It's already in place. I think Austria, Denmark, for example, have those safeguards.
Yes, I think to that point, I think, and maybe this would be worthwhile doing, is actually doing a real kind of comparison across the different jurisdictions as to how the mortgage market works, because it works very differently in different jurisdictions. So we've talked before about the extent that there's kind of long-term fixes in the system here, how those are funded, how breakages work, and so on. There's lots of really good information that can be drawn from cross-country comparisons. I genuinely am of the view that we have a system today, and will be increasingly the case, that mortgages will come through both banks and non-banks. And it's important that whether a loan is originated in a non-bank or purchased by a non-bank, that it works in the same way, that they are complying with, they have the same codes, same regulations, same requirements as the banks do in terms of the treatment of that borrower. So I am okay with loans transferring between.
Okay, can I ask, Mr. Tobin, you've got you've got a written submission from the Attorney General which states, is it right, that this bill is unconstitutional?
There has been correspondence from the Attorney General which says I'm not sure if I'm allowed to directly quote legal advice, but that there's a serious risk that it could be unconstitutional.
Okay, so there is a risk, yeah. Okay, which is fair enough. I see that as a fair comment. I think it's different from actually saying that the Attorney General says that the bill is unconstitutional, which some of the headlines are out there, because there is a risk, because we all know what the Constitution says. Property rights are protected under the Constitution, but they're also limited in terms of their protection. And the real question here is what is the common good and what is social justice limitations, and that's what needs to be tested in my view. But that's a fair comment. Can I ask you in relation to do you believe that the code of practice by the central bank on the transfer of mortgages, which is basically more or less this legislation, do you believe that banks should adhere to it?
I think the 1991 voluntary code of practice is an arcane code of practice that was put in place at a time when building societies, as I understand it, were demutualising, and there was a concern that if individual persons' mortgages were sold, that those persons could lose out on a kind of a windfall cash gain when the building society was demutualised.
So when do you think it was when do you think it became out of date or obsolete?
Honestly, I don't know. That's just my understanding of why the circumstances around which it was introduced.
So when Minister Noonan answered a parliamentary question to the now current Minister of Finance, Paschal Donoghue, and when he said, notwithstanding the voluntary nature, I expect that best practice to take that the code be applied by all institutions to all classes of residential property. Now, did you have a view on that, or did the department have a view on that? Because usually these parliamentary questions are signed off on by the General Secretary of the department. The Minister doesn't put these on the record without...
I think it's the General Secretary. I think it's the Secretary General, Deputy. Sorry, it's just when I hear the General Secretary, I always think it's General Secretary of the Communist Party, but it's Secretary General of the Department of Finance. But sorry, I'm not aware exactly of that individual parliamentary question. But I think that the central bank has said today
I've made you aware of it now, and like my bill, it's nice and short. So Minister Noonan believed that, which he was at the time the majority shareholder in 3 of the banks, and I'll read it to you again, the section. Notwithstanding its voluntary nature, I expect that the best practice dictate that the code be applied by all institutions to all classes of residential property. So the Minister for Finance was saying on the Dáil record, which obviously would have been approved by the department, whichever General Secretary or Secretary General version you want to take of it. I think it doesn't make much difference, that the code should be applied. It seems that the change of heart here has that somebody actually said, you know something, since 1991 no bank has ever applied this code, and maybe we should do something about this. And as soon as somebody says let's do something about it, these are telling us that the sky's going to fall in.
Deputy, I think the central bank, and again, I don't mean to put words in their mouths, but I think the central bank has said that the code is redundant and that they're intent on removing it. So that would also be our view.
Why did the department sign off on this just 7 years ago?
I honestly don't know. 7 years ago, I wasn't working in the area.
So can maybe Mr. Palmer, can you give was it the view of the department, obviously it was, that 7 years ago, or just less than 7 years ago, that the bank should all be applying this regardless of its voluntary nature, and now you've had a turnabout on it?
Well, I'll claim Gary's excuse. I was elsewhere occupied in the department. I think it would be fair to say that the issue certainly got a lot more attention and study when you proposed your bill.
Listen, thanks. We've had a long day anyway, and thanks for the contribution and for the engagement, and hopefully it'll continue.
Thanks, Deputy Doherty, and my thanks to both parties for agreeing to have the joint session, and acknowledge again the independence of the Central Bank. Thank you very much for attending. The meeting is now adjourned until the
Thursday, the
4th of April.
at 9:30.
9:30.